This continues because Shell has reiterated this morning that it's not interested in BP, and in so doing, it has triggered one of the rules in the takeover code in the UK, which means it can't bid for 6 months. Does that have further to fall then, BP, on its London listing? We'll watch that. H&M, we had numbers out from the fashion retailer a little earlier on, and in defence, we've seen Rheinmetall, Rolls-Royce, BAE, changes in broker recommendations on all of those three businesses this morning, Guy.
Yep, lots of things to pay attention to on the single stock story. We'll come back to that in just a moment. Let's deal with the indexes first of all. Time for the opening trade. And we are expecting a little bit of underperformance from London at the moment. We have that beginning to come through. There it is. There you go. We're down by a staggering less than 1/10%. So we'll see whether that gains momentum on the downside. Elsewhere, we're going to watch very carefully to see what Madrid does this morning, whether or not the underperformance is going to continue there. What else are we going to be watching for around Europe? Not sure there's much kind of forward momentum, but as I say, you need to keep stepping back and watching other asset classes. What is happening with euro-dollar right now, what is happening with sterling is something you want to pay attention to. Remember, there's quite a big mechanical process between what happens with sterling and what happens with the FTSE 100. There's a lot of international businesses within that index. There's a direct translation effect that you want to factor into your thinking. So here we go. The IBEX is actually doing okay relative to everything else. We're only up by 0.3%, but that's pretty much in line with what we're seeing on the Stock 600. We'll wait for the Swiss to get going in a few minutes' time. In the meantime, let's talk about sectors. Critty, what you got?
We're seeing a little bit of a mixture of sectors. I mean, right at the top of the barrel, we are seeing the likes of, I'm seeing a little healthcare, a little energy, a little banking, but all in all, the sectors are broadly positive across the board this morning. But to me, I think it's kind of interesting because it is a hodgepodge. And I think you used the word jambalaya in yesterday's session.
No, you did.
We're going to get Guy Johnson on the jambalaya train. It is a jambalaya of stocks. It is a mixture of stocks this morning when it comes to the upside. And I'm seeing Shell as your kind of biggest index contributor to the upside, but a slew of healthcare names sprinkled in there as well.
Yes, absolutely. So we'll continue to watch that. I mean, Basic Resources is actually on my screen the best performing sector. And just looking at what we're seeing from the underlying commodities, I see iron ore prices up by 0.5%. So that's something that maybe we've under-mentioned today. But oil prices are also stronger, and that's probably worth mentioning as we're watching for BP and Shell and how they respond to that their own, that narrative and that sort of merry dance we were led on yesterday, and Shell's denial. So as a result of that, it seems that BP is quite resilient, and partly that might be to do with the fact that energy prices are higher today. So oil prices are going higher.
In some ways, nothing has happened for BP. From
but
a London listing point, but you take away that bid. You do.
Yes, exactly. For 6 months, if there can't be a bid, I thought maybe we might see some downside, but no, not today. Up by 0.4%.
Yeah, there's massive debt financing story in the BP piece as well. We'll get a little bit more insight on the merits of that deal shortly. Like you said, it's a couple of moves we're keeping an eye on. I think Unilever is taking a little bit of a hit this morning, which is interesting. Whereas banking, commodities, the cyclical story seems to be outperforming. I think that's where I want to go next here. Maria Weitmana joins us around the table, equity research head at State Street Global Markets. Lovely to see you in person. Thank you so much for coming in today. Talk to us about this kind of cyclical bid. It feels like there's elements of it in today's market, but we did a little bit of digging when it comes to the outperformance of Spain. Spain seems to be in the news in the last couple of days. And the outperformance of Spain is similar to that of Germany, but for cyclical reasons, whereas Germany is more of quite literally a defensive defense trade. Talk to us a little bit about how sustainable a cyclical bid in Europe is.
So, first of all, thank you for having me in the studio. Love coming here. I think I would probably split your answer into two parts. So I'm quite optimistic on cyclical sides, but not in Europe. Okay. so I'm incurable optimist, and I mean, I love U.S. stocks. So for me, that's where the cyclical side is. I mean, yes, U.S. economy is weakening. Yes, trade war is not great for U.S. economy, but is so much worse for Europe. So that's where I think I draw the line. So yes, U.S. economy maybe is not doing as well as we hoped at the beginning of the year, but it's still doing a lot better than other areas. And we see actually quite a strong cyclical beat there. When we look at institutional investors' flows from State Street custodial database, they are buying U.S. cyclicals, tech, industrials, materials. So those sectors get bid. They're selling healthcare, they're selling staples, they're selling utilities somewhat. So there is a very, very cyclical trend in U.S., but not in Europe. That's one place where we don't see it. And actually, talking about Spain, that is really interesting. And German investors build up big positions in the first half of the year. We see very sustained selling over last months. Spain and Germany probably the strongest one of those in the region.
Well, explain the bearishness, or perhaps around European cyclicals a little bit, because the bull case for Europe right now in the cyclical space is the massive infrastructure spend this market is pricing in, not just from Germany, but from other places as well. If the likes of France, Spain, Italy don't spend on defense, they're still spending locally. Shouldn't that be a positive for cyclicals in this region?
Well, I think investors in particularly within kind of thinking about Europe, is really show me the money. I mean, there is a lot of talk, definitely, and European politicians have talked about spending, and we know that we need to spend in Europe, absolutely, no question about it. They haven't really started spending it, so I think, but what has happened is that investors build up positions. We know that Europe performed well, so I think it's a little bit kind of, a lot of this hope for cyclical spend is already there in the price, and then people saying, okay, when it's coming, where it's coming, maybe, and we know how kind of slow European bureaucracy could be, and I think the questions begin to creep in as Europe is not spending yet. So maybe that's kind of position adjustment, that's what's happening. So big positions, valuations kind of got there to some degree, and people are questioning it.
That's been the case for 6 months, no? It's this question, so why is the market rallying if these doubts have existed for not just 6 months, but years?
So I think, like, if you take like step back, so investors were underrated. I mean, you're absolutely right. So those doubts existed for years, and exactly that what we see investor holdings. Investors were underweight European stocks for best part of last 20 years, and they underperformed, and earnings were weak. The only periods where people were interested in European stocks and started building up positions where earnings expectation in Europe were higher than the rest of the world. When you expect Europe to outgrow the rest of the world, then yes, people go in and buy European stocks. That was a hope in Q1, but it was really hope. We haven't seen European earnings being stronger than the rest of the world, stronger than US. I mean, if you look at earnings expectation on the Dow Jones 600 for this year, I mean, last year it was negative. This year we're trying to get to kind of small positive numbers. It's still like order of magnitude less than US, right?
And a lot of people would point to the fact that some of the things Germany and others are spending on take time to be delivered and don't show up just yet. But let me take you to the US, Maria, because we know your enthusiasm for US tech. And so that makes me think of NVIDIA. We saw NVIDIA once again going to a record, AI enthusiasm driving it there, reclaiming its largest stock title, so the largest stock in the world. Does your optimism extend to NVIDIA, based on NVIDIA, happy to own and load up on NVIDIA from here?
I mean, we don't do like individual stock recommendation, but definitely positive on semiconductors. That was the strongest demand is. And actually, we're talking about Europe and US. So if you look at multiples, like 1 year forward PE, Rheinmetall is almost twice as high as NVIDIA. So people are worried about NVIDIA valuation. I mean, okay, it's big number. Rheinmetall is a lot bigger, and people are really enthusiastic about it. So that's kind of a sentiment thing. But for us, NVIDIA, I mean, what I want to own in my portfolio is companies with high margins, high growth, stable earnings. What's NVIDIA margins? 70%. How many companies you have with that sort of margin?
Yeah.
So I'm really enthusiastic about sector. And to me, what was really interesting about NVIDIA latest earnings was that, I mean, NVIDIA is told that they're not allowed to sell to China anymore.
Some things.
Yeah, some things. So $8 billion hole in your revenue stream took them all of 10 minutes to find new customers. So that's the strength of the balance sheet. That's the strength of consumer base, which is really unparalleled in current times of uncertainty. Companies don't know.
And given all the challenges that the US sort of macro case faces at the moment with the weaker dollar and policies associated with that, does US exceptionalism, is that where we should focus, on US tech? Is that the US exceptionalism story that matters to you?
Yeah, absolutely. As an equity investor, it's all about tech. Tech is majority of earnings growth with strong margins, absolutely. We don't share the same enthusiasm for treasuries, for dollars. That's where we see investors' sentiment as being very weak. So it's really US tech that supports stocks and pulls them higher.
The IBEX has done 35% year to date in dollar terms. The Nasdaq has done 3%. It's a 10x difference.
Yep.
If we go to 120, that number's going to look even bigger. Does it matter what companies are doing if investors are facing the kind of headwind they are with the dollar right now?
I mean, it's a really interesting question because so far, so if you think back to the last 5 years, foreign investors, I think like Europeans, they've been reducing dollar hedges consistently for the last 5 years. And now it's kind of the moment that dollar hedges are low and people think, okay, should we hedge more? And I think if they did, that would be a really strong signal that, okay, it's, I mean, hedging is expensive, right? So if they start hedging, that would be a really strong signal that, okay, we think that's something structural changing. So far, we haven't seen it. We have not seen it. So maybe on the margin a little bit.
So the market doesn't believe the dollar continues to decline?
I mean, FX investors absolutely do.
Yeah.
So the short
Equity investors?
Equity investors not there yet.
Okay. Why do we still believe there's cyclicality in the States? Isn't the chance of a US slowdown growing? So why do I want to own cyclicality?
I think it's a relative story. Yes, US is not as exceptional as it was at the start of the year, but still more exceptional than anything else.
Sure, but all the money's there.
Yeah.
So if it is still more exceptional, it's just less exceptional.
Yeah.
So does it deserve less money?
I mean, we've seen a big position unwind in Q1, definitely. So investors gone closer to benchmark, and now
still they massively overweight.
Massively overweight, yes, absolutely. But they're rebuilding now, and I think to me the turning point was when in investor flows when. Tech CEO stood up and reconfirmed the earnings guidance and reconfirmed the strong profitability and capex. No other CEO in the world pretty much was able to give any clear evidence. And tech did it. And that pretty much since then, we've seen every single day buying of tech stocks in institutional investor flows. So investors basically say, I don't know what's going to happen, but I know tech earnings are going to be strong. And that's where they went.
So one of the concerns around cyclicals, one of the bearish arguments around cyclicals in the States, but I'd argue you could say this about Europe as well, is that in the face of volatility, in the face of tariffs, wars, et cetera, surging and changing oil prices, capex, buybacks, a lot of things that people love, to your point, gets halted altogether, and then ultimately it pressures margins. Could you make the argument that because of the amount that the tech companies are spending on infrastructure, on real estate, on data centers, that they could eventually, if not already, be trading like cyclicals? Warren Buffett made this argument years ago that Apple is ultimately a value stock at the end of the day. Is there merit to that argument?
I mean, to some degree. Actually, before that, I probably push back a little bit on this capex idea, because capex did not exist in US outside tech. I think, like, overall, yes, capex numbers were positive, but it's all only in tech sectors. Because where capex coming from? Coming from profits? That didn't really exist very strongly outside tech. And from bank lending. And we know CNI lending was barely positive. So capex didn't exist. So, I mean, yes, I think what uncertainty created is that it stopped the hope for capex. It's a little bit like European case. Yes, we were really optimistic about all the spending. We were really optimistic about new administration deregulation policies and potentially like easier tax regime for capex. Okay, that's not happening, but it wasn't happening before. So it was really tech that was kind of investing and doing capex. And I agree with you in terms of Apple. I'm not sure I would call it value stock, but definitely call it quality stock. That's definitely true. Thinking about how big the balance sheet, how resilient it's to anything. And I mean, it's a lot less kind of dependent on what Fed does because the balance sheet is so big. Barriers to entry are enormous.
But it has so much cyclical exposure, Maria. I mean, isn't 33% of Apple simply on the Genius Bar? It's a luxury-driven story.
It's definitely luxury-driven story.
Not to mention its international exposure, so the FX story. I mean, there's a lot of reasons not to own Apple if you're not feeling super positive on the cyclicality of the States.
Yeah, but I mean, on the other hand, it has balance sheet like of behemoths and cash flow of enormous cows. So what can you do?
It's a small country.
Oh, yeah, bigger than some countries.
Yeah.
Well, I come from a small country. So.
We'll leave it there. Small countries, big countries, markets that go up, markets that go down. It's different. You've got the small countries actually doing relatively well at the moment. We're going to talk more about the euro as we progress. Maria, it's fantastic to see you in the studio.
Oh,
come back often. I know the weather in Milan is quite hot at the moment, so you're more than welcome here in cool Britain. Maria Weidmana, Equity Research Head of State Street Global Markets. Core 6 looks like this. This is what we're looking at, as you can see. Mixed performance. Ferrari had a good day yesterday. SML softening up a little bit. Nestle's doing nothing, going sideways. So that tells you something about where the defence bid is right now. Defensive, I should make that distinction. LVMH and Novo up a little bit. Let's get some more details with Joe Easton.
So after all of that excitement on BP and Shell, we're pretty much where we were yesterday on those share prices. We can see BP only up 0.2% at the moment. Shell actually managing to gain as well, up 0.4% at the moment. We saw all that movement in the ADRs in New York yesterday with BP jumping, Shell dropping, but pretty much nothing happening, given we've had this statement out this morning from Shell saying they have no intention to make an offer. And as was explained earlier on the show, potentially this means they won't actually be able to do a bid for regulatory reasons for a while. So, as I say, a lot of excitement overnight, but not very much excitement at all in Europe today on those stocks. But then over in the fashion space, H&M getting a big gain today, one of the best performers. This is after better than expected operating profit for the Swedish clothing retailer. It has underperformed a lot against the old rival Inditex, Zara, which is kind of a higher pricing point maybe, but they are seen as kind of stock market rivals. But H&M coming back up this morning after a lot of downside in that stock over the past year, so decent gain on that one today. Then over in food vouchers, meal vouchers, Eden Red, which is a quite well-followed stock. Decent market cap, around 6 billion market cap, getting a boost today on French government reform on meal vouchers. So the French government is going to fully digitalise meal vouchers, and that is seen as a positive for Eden Red. They also haven't announced a cap on merchant fees, so another positive for that stock and getting a bit of a boost. It's another one that struggled recently, so Eden Red doing well this morning. Then lab stocks moving the right way after the gain we saw in US peers yesterday. Some reports out saying that potentially cancellations of some research projects aren't going to happen for now, and that boosted a lot of the US stocks in that sector. And we're seeing that feed through into Sartorius and Sartorius Steadham. Don't quite know the difference between those two. They're both called Sartorius and they're both higher today. Both of those getting a boost. Then over in rating changes, ASML, this is an interesting one. Jefferies writing they have severe concerns around the Chinese market. They've had a buy on ASML for around 4 years, and they're finally downgrading to hold this morning. That one is slipping very slightly as Jefferies cuts it. And then another downgrade here in the UK, Rolls-Royce cut at Kepler Chevron. Everyone really positive on this stock, but finally a bit of valuation concerns coming in, given that massive rally on the aerospace and defence boost for that company. Rolls-Royce cut at Kepler Chevron this morning, pretty much unchanged on the London market this morning.
Joe, thank you. Joe Easton from our equities team. Coming up, we'll deep dive into some of the stocks on the move this morning. H&M shares jump after profits top estimates at the fashion retailer. Details ahead. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Bloomberg
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Welcome back. 20 minutes into the equity market session. The world looks like this morning. Nothing much doing. Little gains, a few gains seen across Europe. It's interesting that the FTSE 100 is flat as a pancake. Elsewhere, you are seeing a few more gains in Germany and in Spain this morning. They're the outperformers, which is interesting considering what Trump had to say about Spain yesterday. One of the stories we're certainly focusing on from a London point of view is what is happening in the oil space. So Shell out this morning with quite a strongly worded denial related to a Wall Street Journal report yesterday that the company is in active talks about acquiring rival BP, saying no discussions are taking place. No discussions are taking place between Shell and BP. We'll get into the nuance of that in just a moment. And as a result of which, in some ways, nothing doing from a European perspective. We saw a massive move yesterday around the ADRs there. Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities, joins us now. It's an important distinction to make, though, isn't it, that the companies are not talking. The journal story clearly kind of went too far, and it gives Shell the ability to issue this very strongly worded denial this morning. Doesn't mean there's kind of no smoke here.
What we do know is there's been an awful lot of speculation about the future of BP in the last few months, and BP shares have underperformed strongly. We've got an activist investor, we've got a CEO who isn't getting the best notices and whose strategy is under scrutiny. And in that situation, you get M&A speculation. With these companies, there isn't a very big universe of buyers. Shell is the obvious buyer. You create a giant UK oil company. So this speculation has been going on, and we wrote a story a few weeks ago that said Shell has been running the numbers. It's thinking about how it needs to play this, what the deal would look like, what the relative valuations look like. So yes, it's an idea that is out there that's being discussed, but Shell has been able to come out and deny very strongly that there are any talks going on right now. And I think the significance of that is that this puts this off the table for the foreseeable future, because under UK rules, it can't make a bid now for 6 months in most circumstances.
Well, can we just explore the hypothetical for a moment, which is that if, let's say, in 6 months' time, we have this conversation yet again, outside of them being two big UK oil companies, in terms of the actual business, what are the synergies?
Well, I think with oil companies, you get to spread the cost base over a wider area. I think BP would bring a couple of things to Shell. It has a very strong portfolio in the US. It has some very, very enviable assets in the Gulf of Mexico, which is an area which could drive growth for Shell, which has some say a slightly limited growth profile going forward. It also has a shale business, which is something that Shell got out of and might want to get back into. The other thing to focus on is trading. These two companies have the two strongest trading businesses among the oil majors, and bringing it together would create a real force in trading. Now, that would come with antitrust issues, presumably, but it would also present an enormous opportunity to really trade around the assets that this big company would have.
And just briefly, well, I mean, BP didn't drop this morning. We wondered whether it might, given the strong denial and the 6-month clause, but it didn't. I mean, oil prices are higher, so I suppose that might be the driver there.
Yeah, I mean, there is some stability in the BP price. It's found its footing, and obviously is getting some support from the oil market. It did. The US shares went shooting up and shooting back down again yesterday because this was a formal denial this morning through the stock exchange, but they did come out with a press statement last night to deny the story quite quickly.
All took about an hour, didn't it, from that spike up 10% to back where we started, roughly. Will Kennedy, thank you, Bloomberg Senior Executive Editor for Energy and Commodities. Let's pivot from energy to fast fashion. H&M shares surging this morning after the Swedish retailer reported better than expected profit, helped by tighter cost controls, we understand. Charlie Wells has all of the details you need on H&M. So what are we getting then from this report from H&M, Charlie?
So, Anna, we're getting signs of a turnaround. And I think the connection to oil is that these big fashion companies are kind of like tankers. They're huge. Very good. They're really hard to turn around once you got going. And a number of these retailers really kind of got caught out in that kind of 2021, 2022 sort of post-pandemic inflationary era. They just had the wrong strategy. And H&M really was one of them. Their management has really been focusing on trying to turn things around, on trying to focus on that core brand, on trying to have price discipline, on trying to have cost discipline. And this is looking like a sign that that could be happening, that finally that strategic pivot that they've been trying to take could be catching hold. And we're seeing this with a number of other retailers as well. But this is a kind of an evidence point there.
Talk to us about some of those other retailers. Talk to us about their peers.
Well, look, so one of the main competitors here is Inditex, right? The Zara parent. And they actually had kind of disappointing earnings earlier this month. They had kind of, softer sales figures going into summer. This is a really important moment for these retailers. And actually, though, when you look at strategy, you can see H&M trying to kind of copy from that Inditex playbook, which is to have more of your suppliers closer to home. This is a little bit of that deglobalization play. Inditex does not source as much from Asia, and so H&M is trying to start to do that. We could see that pivot start to play out, but there's something bigger here in retail, and I think this is something that H&M is also going to have to focus on too, which is trying to appeal not just to that budget consumer, because if you look at shares in the retail space that have really been overperforming this year, it's been that mid-market luxury, so H&M trying to target a higher income consumer.
I'll draw a connection to Nike, because they both, H&M and Nike Vietnam is a big supply story, so the trade talk is going to be fascinating. I actually want to talk about snowfers.
This is all guys wanted to talk about.
So let's talk about snowfers, okay? So Nike numbers are going to be out a little bit. That is a snowfer. I have no idea why somebody would conceive of such a thing.
Does this exist in the real world? This isn't just a sort of AI creation.
Apparently people are buying them before they're even released, which tells you that maybe Nike's getting a little hotter.
Well, yeah, they've really struggled. People have said that their designs are not innovating quite as much as they need to. I don't know if you look at these images, if you think this is innovation. Maybe this is kind of a Gen Z trend sort of picking up. And I think the thing that they need to do, though, is build hype. And in some ways, the snowfer is doing that.
Looks like it was invented by a large language model.
Well, it's a loafer with a swoosh, with a Nike swoosh, right?
Excellent.
Why would you think that's...
You know what we're going to do? We're gonna charge it to the Amex. We're going to have Guy Johnson test it out, and then we'll have him report on it. Charlie Wells, thank you so much. Coming up, we go right back to the defense conversation. What shows up in private wealth? This is Bloomberg.
Bloomberg launches our inaugural 25 African startups to watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. we're able to store energy in the form of ice as opposed to storing energy in the form of lithium batteries. We're integrated in every refrigerator, a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
This is the opening trade, 30 minutes into today's session. Thursday, the 26th of June. So far, it looks like this, making very modest gains across the board, up by 0.2%. The FTSE 100 underperforms, as we anticipated, Kriti. The best performing sector is retail, and the best performing company within that is H&M, as we have discussed, beating expectations there. That stock up by more than 7%.
It's a weird Thursday because there's so much green on the screen. It's been a very volatile week. There's been NATO, there's been defense questions. We started off the week talking about strikes in the Middle East. Tariffs and trade negotiations have surfaced in there as well. There's a lot of volatility. The market feels a little calm right now. We'll see how long that lasts, which gives us a moment to discuss the implications for some long-term assets. The perfect person to talk about it joins us here on her whirlwind tour, Elisa Wood, a partner at KKR. Elisa, we usually meet on private equity-focused conferences around the world, but I thought this was a great time to talk to you about how people who want to be building up exposure to long assets, whether it's in the private markets, et cetera, should be thinking about the volatility, an example of which we've seen this week.
Well, this is a moment where I actually think complexity and volatility to experience sets of hands is a good thing. So this is, I think the biggest thing investors have to really make sure that they lean into is staying invested in this market. Not being invested, not trying to get deals done, not putting capital to work, I actually think is a greater risk than the complexity and the volatility itself. Trying to time the market is just foolhardy, right? If you're waiting for the perfect environment to put capital to work, you'll be waiting forever, right? Like that's the biggest, I think, issue out there. So if you look at the complexity that we've seen both from a geopolitical standpoint, from a macro standpoint, whether it's interest rates being higher for longer, stickier inflation, some of the geopolitical sensitivities around the world, you can still invest behind some very, very interesting themes, whether it's digitization, whether it's industrial automation, this whole transition that we're seeing in corporates going from capital heavy models to capital light models. You know, the more volatility that we're seeing, the better it is for public to privates. Right, at KKR, for instance, in the last 2 years, we've actually just executed 25 of them. Now, if you look at the couple of years before that, it was really hard to get a public to private done when everything was up and to the right. When you look at corporates having to really invest in growth, this whole trend of deconglomerization, you know, this benign globalization coming into a period of more great power competition is allowing for corporates to have to shed non-core assets. That's a great buying opportunity. So I think at the end of the day, there's also a real appreciation that you have to be invested in the private markets. Now, Over the last couple of decades, I'm not so sure everyone necessarily appreciated that and agreed with that statement. Clearly we did, obviously, doing private equity and investing in the privates for 50 years now. But when you think about the correlation between asset classes, and I think this is what's really coming home and coming through in a lot of what you're seeing around the world, the correlation between asset classes has fundamentally shifted. So things that weren't correlated today are extremely correlated. When you look at the return compression that you're seeing in the public markets and places, you've got to lean into private markets, and private markets actually can close that gap. And I think when you also take a step back, we've seen a real change in the public markets as well. There are 40% fewer public companies today than there were 20 years ago. Yeah. So if you're only using the publics as a way to really drive your return, good luck on some of that.
I think it's fascinating that you're talking about kind of the reverse engineering of publics to privates rather than privates to publics, which has been the massive trend, I want to say, of the last, at least since the turn of the century. Talk to us about how much of that is driven by perhaps extra volatility in the equity market or maybe the bond market volatility. What's leading that trend?
So I think it really comes down to we're very micro in how we think about the world, right? So every situation is a little different. But if you talk to the CEOs, if you talk to the management teams, you know, you have two choices. You can be public and you can manage to quarterly earnings and really focus on that every single day of the month, or you can focus on how do you grow your business? How do you think about organic and inorganic growth? How do you think about M&A? How do you think about operational excellence? All of those things are really hard to do when you're a public company and you're managing to that quarterly time frame. So I think there are a lot of management teams, founders, entrepreneurs, owners who going public was the end all be all. And today it's not. It's actually having a partner in the business who can provide capital, who can provide operational excellence and know-how. And you can do some great things together outside of the public eye. And I think that's actually what's driving this huge draw into making sure it's more of a partnership model than this whole end line of sight and being public.
You started the conversation saying you've got to be invested. How many conversations do you have with people who are worried about being invested? I find it fascinating that that's where you started.
You know, it's probably, I'm saying some of that coming off of this whirlwind tour where I feel like that's a conversation that I'm having in every meeting. You know, I think there is a lot of nervousness in the market, right? Yeah. There's a lot of let's sit and see where the next couple of months takes us before maybe we lean in. But if you actually look at the data, I think sitting on cash is something that has not served anyone well in any of these periods of volatility. So if you look at these, whether it's the dot-com bubble, SARS, COVID, taper time, pick whichever one you want, right? It was those who sat on the sidelines in those periods of time and didn't lean in that actually had the biggest impact of negative performance or lack of performance in their portfolio. So I think there's a real understanding with investors that what got them here, there has been great performance over the last 5+ years, right? It's not going to be what gets you going forward. And I think that is the understanding. And there's the fear of that if I don't do something, if I don't, it's more stay the course than anything else. It's not the great pivot. Everyone keeps asking me in these sessions, like, so what's your pivot? The only reason you pivot is if something's not going well, right? Okay. If you can stay the course, I think that's...
But there is a sense of paralysis at the moment.
You know, I think that's changed. I think there was a paralysis, you know, across investors the first couple of weeks after April 2nd. But I think there's been a real change in that, right? Because this feels like more of the norm for a longer period of time. This isn't going to go away. The geopolitical complexity, the volatility in the market, this is going to be what it looks like for a period of time.
Do you get the same returns in that kind of environment?
We get better returns, actually, and I think that's the key. So if you look at private equity as an example, what good looks like in the industry is somewhere between, you know, call it, the industry median is probably 500 basis points above the public markets, whether it's S&P or Russell, pick whichever one. Best-in-class managers, I would like to believe we're one of them, are somewhere between 700 to 800 basis points above that. Now, if you look at periods of volatility, like some of the ones that we just said, the performance for those top best-in-class managers is somewhere between 2 to 3 times what normal is. So that is, I think, what we're getting the message out more. So it's not just the 500 basis points. You're actually talking about many multiples of that if you don't stay the course.
Elisa, can I ask about exits then? Because maybe that sets the stage for being able to do some of those exits. And yet IPOs sometimes look challenging, maybe because the market is worried about some of the volatility that we've been experiencing, as we've discussed. But you make the point that there are other ways to exit. So what do the other paths to exit look like at this point?
Yeah, I love talking talking about exits because I think there's just so much misinformation in the market on this topic. You know, everyone keeps saying exits are down. They're actually not. The anomaly is the fact that 20% of the capital invested over the last 10 years was invested in one vintage year, that being 21 and the beginning of 22. And that has really skewed the numbers. So if you're relying on one path to exit, IPOs as an example, it may not be the best answer for you at the end of the day. So you need to have multiple ways to win. So for us, the way we think about this is the minute you're through 80% of your value creation plan, what you set out for when you buy the company, you got to start exiting. If you're waiting for that last turn of EBITDA growth, you're going to be probably too late. You can't perfectly time it. So for us, less than 20% of our exits actually come through IPOs. Over 60% of our exits actually come through selling to some type of strategic. Now, a strategic could be another corporate, it could be a family, it could be a sponsor, it could be a whole bunch of different things. But there's trillions of dollars on capital on balance sheets today. And if you can lean into that and not rely on the financing markets and not rely on the IPO markets, by the way, the IPO markets aren't dead, right? There's still a lot of IPOs that are happening. It just has to be the right company at the right time.
Yes.
You know, and having those multiple ways to win, I think is where you're starting to see the DPI come up.
And taking a step back and thinking about the bigger picture and this move that we've seen from public into private and of this boom in private assets, do you see public markets fighting back anywhere? Do you see changes in regulation that make that quarterly reporting cycle less onerous or encourage that CEO who might be dithering to say, oh no, I'm going to stay with the transparency and the listing and I'm not going to go around in private route? Is that happening anywhere?
I mean, listen, I think being public could be the right answer for a business at a point in their life cycle, right? Companies are living, breathing organisms, right? Like they change over time. It might be right to be public at this moment and not right to be public 5 years from today. And that's an okay answer. So that's more of what we're seeing, this evolution of just like you need the right CEO at the right point in a company's life cycle, you need to have the right financing and backers at the right point in a life cycle. And I think we're starting to see more of that appreciation that being public or not being public is not the end all be all in either extreme.
Elisa, you cover private markets. You have a very incredible career in private markets as well, but you're also an expert, a global expert in wealth building specifically. And I think this is a really crucial time to talk about it because there's been this sea change in post-pandemic in terms of where high net worth individuals are looking at not just trading these markets, not just PE exposure, but actually building wealth in a way that is more insulated from the volatility of all this. And it feels like we're having that conversation more in Europe that is still trying to get involved in the public markets. What's the secret sauce to building wealth in the face of this volatility?
I think there are a few things. I think one is you got to think about the long term. Right, if you're trying to solve for 1 to 2 or 3 years out, good luck. It's a lot easier actually to solve for 10 to 20 years out in terms of mindset and visibility and what you can control. I think there's also a real understanding that you've got to make your own luck, right? Like you can't sit on the sidelines and hope for the best, right? Hope's not a strategy. So you got to make sure that the asset allocation that you're employing in your own portfolio reflects more of a real change in thinking, right? The whole 60-40 model doesn't really work anymore if for all the reasons that we just discussed. So really increasing that allocation to privates is a real seed change over the last, call it, decade. Now, I think the third piece is that individual investors, let's be really honest, they're living longer. Everyone's living longer. So retirement has a very different horizon. And what you need to do is not manage to the annualized returns, but really think about long-term capital appreciation, that multiple of invested capital. And how do you get that? You get that by investing in safe pairs of hands, investing in cycle-tested managers who do create their own luck and can balance that perspective in the portfolio.
What about this trend of democratization? How is that going?
Listen, I think it's really exciting, right? This has been something that I probably have spent 25 years looking at and being a religious believer in. You know, when you think about private markets, when I started in the industry 25 years ago, if you were not a large pension plan or sovereign wealth fund, you could not invest in private equity or an endowment foundation. Like literally, you did not have access. Now, I actually think that created a problem in how an individual investor could drive long-term performance, right? You had less ways to win. So needing those ways to win and being able to provide that to a larger group of investors, I think is really important. I do think education, though, really matters, right? You need to make sure investors understand what they're buying and have that long-term perspective to match the assets that they're investing in.
Elisa Wood, a partner at KKR, stopping by in London around the table on her whirlwind tour. We thank you so much, walking us through those dynamics of the private markets, really how the wealthy and wealth should be allocated in this environment. Let's stick with that concept, because this is something that's very much on the tops of minds of New Yorkers right now as they're thinking about who the next mayor of New York could be. A complete turnaround when it comes to the polls here, and something that the New York City real estate market has actively been trading on. Zohran Mamdani's shock win against Andrew Cuomo in the Democratic primary for the mayor of New York. Let's just talk about some of the things he's promised here. Rent freezes in the city, free childcare, cheaper groceries, and get this, government-owned shops financed by tax rises on the rich. Now I want to bring back in Charlie Wells here, who in another life also, when he's not doing TV, covers the wealth story. And Charlie, I think this is so interesting here because people are worried about this. It is expensive to live in New York City. It's expensive to live anywhere. It's extra expensive to live in New York City. It's fueled this massive swing to the left. And Wall Street's worried.
Wall Street's worried, and you usually don't see these kind of market moves on the back of a primary election in a mayoral race. So this is not even the general election, right? This is a primary to determine who within the Democratic Party will enter that race in November. But I think there's sort of two things here, right? There's that market issue, which of course, you know, stocks connected to New York City real estate, whether they lend to apartments in New York City or whether they are REITs that have exposure to the New York real estate market, those taking a hit on the back of this news. But again, there's the other piece of this, which is the wealthy being concerned. And then, of course, the concerns that if rich residents of New York City leave, you lose that tax base. And I think I kind of break down the rich in New York into three categories. So there are these sort of, you know, young hotshot Wall Street types who are pretty mobile. You've got the kind of wealthy families in the middle who live in the Upper East Side, Upper West Side. They're kind of stuck in New York. They don't want to leave Dalton or Horace Mann or the Yale Club. So they're kind of stuck. And then you've got the kind of retiree set who love the cultural events. They also have a place down in Florida, and they're fine to go.
The New York Times has got a thing this morning kind of running through who voted. It's a higher income residents, Mamdani. Middle income residents, Mamdani. It was the lower income that actually skewed Cuomo. So that doesn't speak to the story that you're referencing.
Yeah, this is the shift that you're seeing, and it's really interesting in U.S. politics where people aren't necessarily voting in terms of their class interests or even their kind of pocketbook interests. They're voting more on kind of these social issues. And I think one of the things that policymakers and investors are trying to get a sense of is, where does the Democratic Party go post-Trump, right? I know people who are working in D.C. in policy right now who are trying to think of legislative proposals that they will implement if a Republican does not win the presidential election. And that gets at this bigger theme of, where is the Democratic Party heading? And I think the concern here is you take the New York mayoral primary and you extrapolate it out to the U.S. Is that a kind of sign of a leftward move on policy where people are even voting against their own kind of wealth interests? I think that's why there's been so much market reaction to this. Is this the read for the direction of the Democratic Party?
Yes, because if it were just about being the New York mayor, there's still a whole load of steps between where we are now and this person having the levers of power to control the things, the policies that Critty outlined.
And talking about the levers of power, some of these policy proposals that you're hearing from the candidate would be very difficult to implement. So tax raises on the rich, those would have to be approved by Governor Kathy Hochul, who is a very moderate Democrat. She's from upstate, so that would be difficult. We're hearing about, you know, a significant amount of debt issuance here. That would also be challenging. So I think it's possible to read too far into it. There's a chance that this is happening, but I think the reason why there was such a strong reaction was this was a surprise, but also questions over the direction of the Democratic Party.
Yeah. Okay, Charlie, thank you very much. Bloomberg's Charlie Wells putting his wealth reporting hat on to take us through that story. And we should, as we've been talking about that mayoral race, we should point out that the former New York City Mayor Michael Bloomberg, the majority owner of the parent company of Bloomberg News, of course, well, he endorsed and contributed to the Cuomo campaign. So we should make that point.
What we're going to talk about next, President Trump, talking of which, praising NATO plans to ramp up defense spending and reassuring allies on mutual defense obligations. About the number 5%. Article 5. We're going to have the details from Brussels next. This is Bloomberg.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Welcome back. This is the opening trade. It has been a busy week, continues to be a busy week for European policymakers. EU leaders meet in Brussels today in a summit to discuss Ukraine, the Middle East and defence. The meeting comes right after NATO leaders agreed to increase defence spending. Bloomberg's Europe correspondent Oliver Crook is covering the EU summit. He's just been covering the NATO summit, of course. Ollie, break down the details from those NATO talks for us.
Yeah, that's right. And as expected, we had that pledge from all of the NATO members. There was a little bit of dispute about whether or not Spain would get quite over the line, but we did finally get that agreement from all NATO members, specifically those in Europe, to agree to that 5% of GDP spend on defense spending going forward. That has been the big condition set out by President Donald Trump, really after he was elected and before the inauguration, and really a number that I think for most people was thought of to be totally unrealistic, something that, a couple of years ago, as I spoke to the Finnish president, that basically he'd tell you to go see a doctor if you told him that Finland would be spending 5% of GDP on defense. And so that is basically Donald Trump coming to The Hague, able to do a victory lap. I spoke to the Finnish president right after we got the agreement, within minutes of it. Have a listen to what he had to say.
The outcome, I think, was a great success for the whole alliance. So basically what happens is that you set a target, and after that you review those targets through capabilities every year. Technical terms, it's called NDPP. So every member state has to fulfill the targets that have been set, and I'm quite convinced that the alliance, SECURE, and the military staff in general will make sure that the member states do their part.
And so really being touted as a victory, and I think for European leaders in a transaction with Donald Trump, one where everybody can walk away and say that they won. The hard part now, Anna, is actually executing on these promises. You can promise 5% or 3.5% of that is going to be on military hardware. How you pay for it is going to be a different question, and that is going to be the question that is ahead of the leaders that are meeting today, and it is a question that Spain brought into the fore. And as Guy was mentioning a little bit earlier in the show, there is going to be this massive debate here in Europe between guns and butter, and that is actually the point that the Trump administration has made. Basically, Europe, you have all of these beautiful welfare states, you have all these happy societies. Guess what? It's been paid for by the United States, and that is what Donald Trump sought to stop in The Hague over the last couple of days, and that is the agreement that he's got from the Europeans.
Well, Ollie, now that the NATO summit is in the rearview mirror, I know you're there for the EU Leaders Summit. What is on the top of the agenda?
Yeah, so listen, there are going to be a number of different things that are going to be on the agenda here, including defense, including migration. We just had Viktor Orban walking by. I'm very unhappy about migration. He says that he advises all of his colleagues to rebel, because not enough has been done on migration. But those are all, I think, going to be sort of longer burning crises for the Europeans. What they need to do here today is to begin to get on the same page on the trade negotiations. And at the member state level, at the sort of leadership level, what are they willing to concede to the United States? What do they consider to be a good outcome? Because from all the reporting that we have done, things are not going particularly well on those trade negotiations with the United States. Remember, the deadline is about 2 weeks away, July the 9th, when the U.S. says it will impose 50% tariffs on the Europeans. So we're hearing different things from different member states. Some are saying that the demands for the United States are unilateral, they're imbalanced, they do not work. We've heard from other policymakers saying that even that 10% minimum tariff would get a retaliation from the from the EU. But there are other leaders that are saying, listen, we need a fast deal. Doesn't need to be the prettiest deal, but we need to get it over the line. That's the top priority. So that's a debate that's going to be happening today between the leaders of the member states.
Oliver Crook, thank you very much indeed. Ollie Crook joining us from Brussels. Well, I wonder whether they're keeping a firm eye as well on what is happening with the euro-dollar exchange rate right now. A Bloomberg gauge of the dollar has dropped to a 3-year low today. Where does the buck stop? The great question that we always ask here at Bloomberg. Valerie Tertel is here with an answer. What do we think?
Well, look, I think this week has shown us that the short-lived squeeze higher in the dollar around the Middle East tensions is all really but unwound in the last 4 days. You know, the U.S. dollar has weakened over 1% in the last 4 sessions, and now we have a euro trading above a 117 handle, cable above 137. You know, these are 4-year highs for 2 of these currencies. It seems like this, you know, the theme of dollar weakness is really back front and center for markets' minds.
And this is partly because there's an increased expectation that we get rate cuts. And, I mean, this is because of the conversation about who replaces Powell. But even with Powell, I mean, yesterday, did we sense that he was a little more open to the idea that we'll get more rate cuts than previously, or no? Is that to overread?
No, it's really more reading into Trump's comments on Powell rather than Powell's comments in front of the Senate yesterday. You know, the speculation is continuing to grow that if the president continues to get irked by Powell, that we could have a new Fed chair announced even sometime over the summer. That's what a source told the Wall Street Journal yesterday. And the sooner we get a shadow Fed chair's name, if it's an uber dovish pick, you know, we're going to see short-term interest rates at least out into next year to continue to decline, and that'll keep the pressure on the U.S. dollar as well.
Very quickly, talk to us about Michelle Bowman's plan here that's been released. Do we like it? Do banks like it?
It's pretty much in line with what was released to the media last week in terms of the fact that treasuries aren't completely excluded from the changing of the bank capital rules. Now, keep in mind, this is not a final plan. It's been voted on as a proposal, but there's now a 60-day comment period released out to the public. So we could see some continued pushback from those treasury intermediaries wanting a total carve-out for the treasury market when it comes to SLR reform. But after the 60-day comment period, it paves the way for this new proposal to be finalized sometime later half of the year.
A fascinating 180 when it comes to the Federal Reserve supervision story. Do we see that as a roadmap towards how Donald Trump approaches who takes Jay Powell's space? Valerie Tertel, we thank you so much for breaking down the stories that are moving this market this morning. That does it for the opening trade. The Pulse is up next. We are seeing green on the screen when it comes to these equity markets. Outperformance when it comes to the DAX, higher by 0.6%. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, We'll show you how.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jemana Versace in Doha, Qatar, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business. The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Markets bet on lower U.S. interest rates after a report President Trump could be just months away from naming his choice for the next chair of the Federal Reserve. Oil giant Shell says it has no intention of making a takeover offer for rival BP, closing down speculation after an earlier report. Plus, Donald Trump says the U.S. will meet with Iran next week as he celebrates successes at the NATO summit, but threatens higher tariffs on Spain. Well, good morning, everyone. First thing is first, let's check on the European markets map again. A lot of the things are moving on the back of a subtle shift in Fed rate outlook expectations. Now, this is not in what we heard from Jay Powell on that testimony to Congress, but it came from speculation that actually Donald Trump would name a kind of shadow Jay Powell, a shadow Fed governor, and that would influence policymaking in the future. That could come as soon as September. That's according to some U.S. press reports. Now, there's not that much movement on European stocks. You can see the CAC 40, also the FTSE practically unchanged. The big movements, or the bigger movements, is not what's going on with Brent. So we look at, of course, oil overall, but also, if we change the cross asset, what's happening with the 10-year yield in the U.S., 4.2769, and then Brent 67.85. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, bets are growing that the U.S. rate cuts could come sooner than expected. That's after a report that President Trump is considering an early appointment for the next Fed chair. Now, Trump says he has a short list of candidates in mind to replace Jay Powell. The president has been pressuring Powell to lower rates by 2.5 points and took another jab at him while speaking at the NATO summit.
Yeah, I know within 3 or 4 people who are going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible. We have no inflation. We have a tremendous economy.
Now, we're joined by Beata Manti, European Equity Strategy Head at Citi, and our Justina Lee. So thank you both for joining us. I don't think it's 2.5 points, so we'll get to that in a second. But, I mean, the overall sentiment is actually, even if Jay Powell doesn't get replaced, President Trump could appoint someone that would step in next. And so you have like a shadow Fed chair that, you know, that would confuse the markets, Justina.
Yeah, exactly. And it really stole the thunder from Jay Powell's testimony here, which kind of tried to send the opposite message to markets. And what's really interesting about this Wall Street Journal report is that they're saying, you know, Trump could name a candidate potentially by September or October. And even though the next chair wouldn't come in until May, you effectively kind of have this like backseat driver. And I think what the market reaction is telling us, with the dollar depreciating, yields falling, is that even though a lot of these names being floated, Catherine Hassett, Kevin Marsh, are kind of like known quantities to the market, people are expecting someone who would be quite aligned with President Trump in terms of the trajectory of interest rates here.
But I mean, the read across of that is again kind of like a confusion, right? Even if Jay Powell doesn't get changed before his term ends, it doesn't spell any clarity for financial markets.
Absolutely, but if the signal is a dovish signal for the Fed, overall equity markets would like it, right? What you have to think about, what is going to do to the rates differential, what is going to do to the FX, so probably a bit more of the euro strength versus the dollar. This is our base case. And perhaps further down the line, it would help different parts of the market to search further versus what has been driven in the US, i.e. tech, mega cap tech. Perhaps, mid caps will start looking a bit better because they are the most rate sensitive part of the US equity market.
But I mean, it's difficult. The market, I guess, is looking at a possible policy shift from the Fed. That's not what I heard from Jay Powell. I mean, I was listening to the testimony. There hasn't really been a hint from them at all. So is there a worry that, again, they're like dislocations?
It is a possibility. The view from our U.S. economists is a bit ahead of the consensus, ahead of the market pricing, that indeed the Fed will start delivering more cuts than the market is pricing in already this year.
Justina, what else are we looking at? There's, again, a lot of oil. We look at stockpiles in the U.S. and what Donald Trump does of course, with Iran.
Yeah, exactly. I mean, it's kind of interesting that the market seems to have moved on from those geopolitical tensions really quickly. I think kind of, obviously the next dates we're looking at, all coming in early July. First of all, what's going to happen to those tariffs, given that it feels like markets have kind of assumed that we're not going to get a hike back to those highest rates that Trump originally announced on Liberation Day. Another focus is, of course, what's going to happen to the one big, beautiful spending bill in Congress. I mean, that's supposed to move pretty quickly, given that Trump also gave himself a pretty tight deadline here. He wants it done by July 4th.
Beata, the other big story, of course, was from NATO and the defense spending. How much will it give a boost to certain industries in Europe?
We are getting an increasingly positive story from that side, right? So we are talking about 5%. I have to tell you, Francine, that back in February when we had big announcements, nobody believed in 3%, right? Now 3% is a non-brainer. Even 3.5% is probably a non-brainer. The market and market participants are doubting that the 5% is going to happen. Now, 3%, according to our calculations, would translate into up to 3% cumulatively extra GDP for the Eurozone over the next 4 to 5 years, so it is something. And that could add 2 percentage points of extra EPS per annum over the next 5 years. And that's only defense, and that's from 3%. So whatever the number is going to be, it's going to be more now, right?
And Beata, overall, I mean, you have this great insight that is called Navigating Uncertainty. It's basically the mid-year roundup of 2025. Like, what have we actually learned in the last 6 months that you want to incorporate differently in your portfolio from now until December?
So there are short-term risks and long-term boosts for Europe, right? Short-term risks. Okay, from geopolitical conflict perspective, we have a bit of calm. That's great. But let's not forget that we are getting into this July 9th deadline on tariffs. Tariffs have not gone away, and the bill needs some funding from the tariffs. So this is our worry, right? And what we find, we have this geopolitical or geoeconomic, should I say, risk premium model that tries to capture how much of these risks is priced into the market. There were very high risks around the Liberation Day. Right now, after the market rallied, the market is pricing in historically average level of risks. It doesn't mean it's a sell signal, but it means that any acceleration in either policy uncertainty, tariffs, or geopolitical conflicts, higher oil prices, risks, could cause some level of volatility in the markets. That's my short-term worry, right? Yeah. Long-term, it's the stimulus, it's unlocking growth on Europe, could provide more boost to the valuations and cause actually long-term re-rating.
I also want to talk to you a little bit about M&A or M&A possibility, but let's focus on one corporate story. Shell says it has no intention of making an offer for BP, having denied a report that it was in talks with its London-listed rival. Now, for more on this, we're joined by Will Kennedy, our senior executive editor for energy and commodities. Well, I mean, this is something that's been going on for a while. There's been speculation. Bloomberg wrote something on it back in May because BP is so weak. Shell now denying these allegations.
That's correct. Obviously, BP has been a big story in the oil industry over the recent months. As you say, Francine, it's underperformed its peers. Its strategy has been in question. The CEO isn't getting the best notices. So it's inevitable that you do get that M&A speculation. And of course, Shell is in the frame as the most likely and in some ways probably the only really viable buyer, creating an enormous UK oil company. As you say, we wrote a couple of months back that they had been running the numbers. The Journal took that forward, saying that there had been some preliminary talks. Now, Shell has denied that very strongly. And what's important about that is that rules Shell out from making a bid under UK takeover code for the next 6 months in most circumstances. So in that sense, it does move the story forward. And I think it will probably refocus attention a little bit away from the M&A story and towards how effective the CEO, Mario Olkinkloss's strategy is, and what Elliott, the active interest investor that currently owns 5% of BP, is going to do to really drive strategy forward and try and raise returns.
So, well, what happens, I mean, the UK has, conduct authority, basically says that because they said they won't go after it, now they can't do anything for 6 months. Is that right? That's correct.
Once you said we're not going to make a bid, you are bound by that for the next 6 months. There are two exceptions. One, if someone else comes in and makes a bid for BP, and then your hands are untied. And secondly, if BP approaches Shell and said, we'd like to talk about you buying us, they can reopen the discussions, but they cannot themselves make an approach to the BP board for at least 6 months.
Well, thank you so much, Will Kennedy, there, our senior executive editor for energy and commodities. We're back with Beata Manthi and Justina Lee. Beata, I mean, without specifically talking about Shell and BP, are you expecting in this kind of environment just bigger M&A, more M&A?
So M&A activity has been subdued for quite a few years now because of uncertainty and because of the higher rates, right? So we have done a big report with the analysts on uses of cash, asking them where the companies are going to spend their cash flow generation. And the biggest uptrend into the next year, not yet this year, next year, when rates go down and perhaps we have some more uncertainty, is a pickup in M&A. And the sector that has been mentioned the most across all the European sectors is the financials.
Okay, so that's something that we definitely need to watch out for. I mean, M&A, again, we see a lot of reports, Justine, of M&A saying, look, if you're concerned about tariffs because they're on, they're off, and a lot of chief executives may just sit on their hands in general, not only for M&A, but also CapEx.
Yeah, exactly. I think it's been kind of pretty disappointing because I'm sure when Trump was elected, a lot of people thought it would be the exact opposite. And what's been interesting is we've seen a lot of reports of these big deals, right? Not just Shell, BP, but also in the U.S., Northern Trust and BNY Mellon. And we've kind of heard some news lately that maybe, the U.S. is going to rescind this Biden-era rule that's going to kind of put more scrutiny into bank mergers. So are we going to kind of see more action there? And I think everyone's kind of waiting for a bit more certainty to set in.
Okay, thank you both for joining us. Beata Manthi, head of European Equity Strategy at Citi, and our very own Justina Lee. Coming up, we check in on the top lines from the NATO meeting and look ahead to today's EU summit. We'll also be speaking to Carl Bildt, co-chair of the European Council for Foreign Relations and former Prime Minister of Sweden. That's next, and this is Bloomberg.
U.S. jobs numbers are released, Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything.
Welcome back, everyone. Now, EU leaders are meeting in Brussels for a crucial summit. On the agenda, Ukraine, the Middle East, and defense. The meeting comes right after NATO leaders agreed to increase defense spending to 5% of GDP in a win for U.S. President Donald Trump. However, one nation came under fire from him for holding out.
You know, Spain is the only country that... Are you from Spain?
Yeah.
Good, congratulations. You're the only country that is not paying. I don't know what the problem is. I think it's too bad. So we'll make it up. You know what we're going to do? We're negotiating with Spain on a trade deal. We're going to make them pay twice as much. And I'm actually serious about that.
Let's go straight to Bloomberg's Oliver Crook. Ollie, break down the details from the NATO talks.
Yeah, Francine, Spain coming under a little bit of heat, but I think overall this is one of these sort of rare interactions between EU leaders and Donald Trump where everybody can kind of say that they walked away with a win. For the European leaders, they managed to keep Trump in NATO, managed to get him to continue to honor Article 5 and really sort of speak very positively about it. And Trump, on the other hand, delivered on an election promise that he had made, which was to get the rest of the NATO alliance to pay 5% of GDP to go to defense because he feels that the United States has been subsidizing European welfare states by basically outsourcing all of their military spending to the United States. I spoke to the president of Finland just moments after this agreement was ratified yesterday. Have a listen to what Alexander Stubb had to say.
The outcome, I think, was a great success for the whole alliance. So basically what happens is that you set a target, and after that you review those targets through capabilities every year. Technical terms, it's called NDPP. So every member state has to fulfill the targets that have been set, and I'm quite convinced that the alliance, Secure, and the military staff in general will make sure that the member states do their part.
And it's in the interest of a lot of leaders to call this a really historic step. But I think thinking in the context of what this will mean for European economies going forward, I think it's fair to say that it will be. I mean, as you know, Francine, Alexander Stubb had retired from politics. He told me also later in that conversation that if you had told him 3 years ago that he would be president again, that Finland would be part of NATO, and that they'd be spending 5% of their GDP on defense, that you should go see a doctor. But that is the reality that we're facing now today for NATO and the different allies. What becomes the difficulty now, Francine, is the conversation of how you pay for it all. And that's why sort of Spain came under fire. Spain says you can meet all of your defense capabilities without spending 5% of GDP. And that is going to be some of the conversation before leaders today as they descend now after NATO here in Brussels for the EU leaders meeting.
Ollie, the action, of course, now moves to EU leaders in Brussels where you are.
Yeah, that's right, Francine. So listen, there's going to be conversations about a great many things, about defense, about sanction packages on Russia, on Ukraine, potentially longer term, now that you've committed to 5% of GDP, how you're going to pay for it, potentially Eurobonds. But I think the focus from many of the leaders today is going to be getting a sort of collective approach to how to deal with the trade war. Because remember, Francine, that deadline of July the 9th, where 50% tariffs go up between the United States and the EU, is only about 2 weeks away. And from what we understand, the negotiations between the EU and the United States are not going terribly well. We've heard from certain policymakers within Europe that basically the United States has a lot of imbalanced requests, that they're basically unilateral demands of the EU. I just spoke to Teresa Ribera a couple hours ago. She is the antitrust commissioner here in Europe, saying that basically all of the things that the United States wants to push on regulations on U.S. tech firms, they want to tie that as part of the trade deal, are basically off the table. We just heard from Friedrich Merz, who just walked in. This is his first European Council meeting. He says that the priority needs to be getting a deal fast with the United States. So they're going to have to get a collective approach here. Do they retaliate if the United States moves forward with, say, 10% baseline sanctions? Those are questions that we have not yet answered at the EU leader level, and that'll be one of the prominent conversations here in Brussels.
Gosh, first European Council meeting for Friedrich Merz. I'm excited for him. Usually they last a long time. Let's hope this is, not the first that goes also through the night. To our Oliver Crook there, our Europe correspondent, the very latest from Brussels. Now, for more on all of this, we're joined by Carl Bildt. He's co-chair of the European Council for Foreign Relations and former Swedish Prime Minister. Carl Bildt, thank you so much for joining us. It's so great to actually see you this week. When you look at what happened in the last 2 days, it was very clear that the fact that NATO members suddenly agreed to raise defense spending to 5% of GDP was a big deal. How will this change Europe going forward?
First, it wasn't really 5%. We have a definition of defense spending that's been there for years, and by those, and that's according to that we've been discussing the 2% target, and it is a commitment to raise defense spending to 3.5%. That is very, very substantial. Then it was added this 1.5 in order to please President Trump. And exactly what's going to go into that remains to be seen. There's going to be a big accounting exercise that's going to have some entertainment aspects to it, I fear. But 3.5 is a very substantial increase in defense spending. We've seen defense spending going up in the European countries by roughly a third in the last few years. There will be a need to expand by at least another third in the next few years. So that is substantial, that particular result, although not 5%.
Yes, and you're right. I mean, look, for some key European allies, these ambitious pledges, at least in theory, will go up against fiscal and political realities as well. But first of all, is this, Europe coming together to at least try and defend themselves? Is this going to be a more autonomous Europe? Is that the underlying will from European leaders, or are they just pandering to Donald Trump?
Well, there's an element of all of that. But it's going to be, if we look forward, it's going to be a NATO with less of America. There's no question about that. I think we're going to see later during the year a reduction in American military presence. They're doing a so-called force posture review. They do that regularly, but I mean, they have indicated that forces will be reduced in Europe. And add to that the threat picture, the Europeans will have to do more. So there will be a stronger NATO, but a stronger NATO with less America, if we look ahead. And that's sort of a reflection of the global political realities. The Americans are having their focus primarily elsewhere. The Trump administration doesn't see the Russia threat in the same way as we Europeans do, for reasons that are somewhat obscure to me, but that's a reality. So that's where we are heading. And this particular NATO summit could be seen as a step in that direction. The EU summit which has been started as we speak, is another step in that direction.
How do you see it? Is there, there's a growing anxiety over the reliability of the U.S. as a military ally. Will that allyship also finish maybe sooner than we think?
Well, we simply don't know. I mean, the thing with the Trump administration is, of course, it is fairly unpredictable, to put it in mild terms. We haven't a clue, as was indicated just, what's going to be the nature of the trade relationship across the Atlantic in just a couple of weeks. We've never been in such a situation of unpredictability and volatility on key aspects of the transatlantic relationship as we have now. And that means that there will be the need for the Europeans to, yes, hope that the Americans will be with us, hope that we have a good relationship with them, but also preparing for other possibilities. A NATO with less America, absolutely. And Europe reaching out to the rest of the world on trade issues more than perhaps would have been the case before Trump arrived on the scene.
What is the right way for Europe to navigate actually the U.S. right now, even if we see what happened in Iran over the last 10 days. There's certainly intelligence from the Pentagon that seems to contradict President Trump. What's the right way for European leaders to deal with this contradiction?
Well, there are a lot of contradictions. I think Europe must demonstrate that it can do its own thing. Europe needs to concentrate on doing its own things. That is the competitiveness of the European economies. That's going to be talked about between the European leaders during the day and tomorrow. That's going to be the trading relationship with the rest of the world. I think the India relationship, if that can be fixed, if that can be augmented, would be very important. We have the Mercosur, we had a summit with Canada the other day. So reaching out to the rest of the world in this age of Trump volatility is important. China, there's a summit coming up with China at the end of July, which is going to be important to sort of see how that relationship can be balanced. And then, of course, see how one can accommodate these increased defense spending needs with the obvious fiscal realities that are there. There are a couple of countries that have sort of deficits that are too high and debts that are too high. And at the same time, defense spending needs to get up, not an easy equation.
We had a story yesterday saying the European Union, of course, wants China to resolve the export issue on rare earths around these rare earth magnets before meeting with their leaders next month. What is the right way for Europe to approach China right now?
I think the rare earth restrictions that or export controls, to be precise, that China put in place were a reflection of what the Americans did on high tech. I mean, the Americans had on high tech that we have export restrictions and they are dual use, and accordingly we deny them to certain parts of China. And the Chinese are saying exactly the same thing, that the rare earths are dual use and we have exports control and we deny them to some. Europe shouldn't get into that particular fight. And I think we should seek some sort of accommodation with the Chinese so that we are sort of outside of that particular part of the battle in order to have the more or less secure supply of rare earth minerals. Then long term, of course, we need to have a situation where we have less reliance on just one sole supplier. But that's going to be one of the issues. Then there's going to be a number of other issues. I mean, the Chinese are less happy with the tariffs on EVs, and there are European concerns on overcapacity. But it's a fairly full agenda. But hopefully the possibility of sorting that out in a constructive spirit.
Mr. Bildt, I mean, overall, what's the biggest danger for Europe right now? I know we've talked about, crises, about things that Europe needs to deal with. I don't know whether you were uneasy when the NATO Secretary General showed a lot of flattery towards President Trump, or that's the right way to be negotiating or dealing with the U.S. right now?
I think he perhaps overdid it. Perhaps not even slightly, but overdid it significantly. But I mean, flattery does seem to work with President Trump, but there should be a limit even to that. The greatest danger, I mean, no question about that, is the Russian aggression in Ukraine. President Putin should have I don't know how much confidence he has in the ability of the Russian army to deliver what he wants in terms of win. I don't think the Russian army can do it. So he is counting on the weakening of the will of the West, the weakening of the Trump engagement for a ceasefire. It's already had that weakening. He's counting on the Europeans not being willing and able to step up when it comes to replacing some of the American support to Ukraine. That's going to be absolutely critical.
Yeah.
Because the future security of Europe. Yeah.
Thank you so much. Future security of Europe, Carl Bildt, their co-chair of the European Council for Foreign Relations and former Swedish Prime Minister.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows, up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Markets bet on lower U.S. interest rates after a report that President Trump could be months away from naming his choice for the next chair of the Federal Reserve. Oil giant Shell says it has no intention of making a takeover offer for rival BP, closing down speculation after an earlier report. Plus, EU leaders gather in Brussels to discuss Russia sanctions, tariffs, and the Middle East, a day after NATO's agreement to spend 5% of GDP on defense. Now, onto corporate, and Grindr, the LGBTQ dating app, has laid out an AI-driven roadmap to fuel growth with plans for several new features this year. Now, the company has recently been growing its headcount to support the developments. Now, analysts at Bloomberg Intelligence forecast continued growth and even expect the company to meet guidance for a revenue increase this year of 26%. Well, I'm delighted to be joined by the Grindr's chief executive, George Arison. George, thank you so much for joining us. I mean, your business model is actually, pretty incredible because you've done so well when some of your rivals have not. What do you think is the secret of your success?
Yeah, so first, thanks for having me. Second, it's great to be in London and a great time to follow the last episode you did because the Secretary General called President Trump Daddy. It's a very popular tag on Grindr for users to describe themselves as daddies or wanting daddies, so I think it's very serendipitous.
Unrelated to geopolitics.
Yeah, totally.
or maybe not. We don't know. We'll keep it open.
So Grindr has about 15 million users, monthly active users worldwide, who use us in a very frequent way, and average usage time is about an hour a day. So Grindr is a really big part of people's lives. In many parts of the world, it's the only way that gay and bi people can connect to each other because we operate both in countries like the UK and the US, but also in places like Egypt, where it's very hard to be gay. And we mainly serve as a way. It started out being a company that enabled people to find a casual date, and over time, users started using it in many other ways. So today, people use us to find long-term relationships. In the US, about 35% of current long-term gay relationships were started on Grindr, which is a pretty remarkable thing. Also for friendships, for networking, and our strategy is to be the gayborhood on your phone, where if you go to Soho, you have a lot of experiences that you can enjoy beyond, meeting guys in London, that is. And we want people to have that opportunity inside the app if they're not living in big cities, a lot of people don't.
And George, this is why you also started something called gayborhoods, right? In countries especially where LGBTQ plus is illegal. So tell us a little bit about that, and again, how that feeds into your bottom line and revenue.
Yeah, I mean, our goal is to not necessarily go after other segments of the population. We want to focus on the user base that we know really well, which is gay and bi men, but do more things for them. And we know that our users spend a lot of money on other products elsewhere, but we think that we can serve them better. So, for example, in the U.S., in the last few months, we launched a product called Woodwork, which is a telehealth product where you can buy ED medications designed for a gay user directly from us. Now, that's in massive beta. It's very early stage, but that's an example of the kind of products we want to offer over time as we expand our brand to more things that gay men need.
And this is basically to grow the business. So is it like an ecosystem or infrastructure to help people and, you know, a certain type of community, and especially countries where it's illegal or
well, even in places like where it's totally legal and you have a very good life, if you live in a small rural area, there are not that many gay people around you. And so your ability to have critical density is very difficult. Like, that's not the case in London, not the case in New York, but even in mid-sized cities, you don't have that many people. And so Grindr is a way for people to connect. That's what a gayborhood is, but we do that on a mobile device at a global scale.
George, would you ever move from a subscription to more advertisement-based business model?
Yeah, we have an ad business. It's about 15% of our revenue, and it's done extremely well over the last few years as we started to invest in it, because we had not been investing in it for a while. And obviously, we would want that business to continue growing. What we've said publicly is we wanted to keep up at the same pace as percentage of total revenue as it has been in the past, which is roughly 15 to 16%. Given that it's smaller, it has to actually grow faster than the rest of the business to kind of keep up with that. And we think that kind of works. The big thing is, you know, advertisers are still very, very nervous about working with companies like us, which is really unfortunate in today's day and age. Well, after like what happened with Anheuser-Busch, you know, a year and a half or 2 years ago, I think there's still a lot of hesitation around touching anything that in any way kind of suggestive of that space. And I appreciate the risk, but I also think it's totally not warranted. And so a big thing for us is getting more advertisers who work directly with Grindr, because we have an audience that people actually should want, right? High disposable income, wealthier audience, more educated, and they usually don't have children, so they spend money on experiences, and advertisers should want that.
And so has that gotten harder actually since, you know, Trump has gotten in charge and there's been a rollback or a pushback against a lot of D&I initiatives? Is it harder to find the advertisers?
We haven't seen that big of a difference post-Trump. Actually, I think it's just been hard for a very long time. When I took this job, my husband was like, you're going to experience homophobia in the ways you've never experienced before, because he had lived in places where it's a lot more homophobia. I had been in places where it's very tolerant, and so hadn't lived through that. And the reality is that that's what kind of we feel is like a lot of businesses that want to be very supportive have these other considerations that make them very stressed out about that. But I don't think it's a necessarily post-Trump thing. It's just been the case for a long time.
When do you see that changing? Do you see that changing?
Well, you know, part of our mission is to be a very successful business, and through our success, drive the world to be a better place for our users. And so I think we actually can do a lot by being as successful as we are and continue to drive for that by then getting people to actually change their opinions, right? The same way that individuals who were gay, who were successful in 1990s and 80s in their own careers, helped change people's perceptions of gay people and were really critical to gay rights becoming accepted. We think as a business, we can kind of have a similar impact on the world.
George, talk to me a little bit about AI, because this could change everything actually in terms of dating apps. So someone who's on your app would have, I guess, an AI agent, maybe doing a little bit of the choosing for you.
Totally. So when I had built an AI company prior to Grindr, so I was pretty connected to AI when I joined, and one of the exciting things about this was just how much data Grindr has. You know, for example, our users sent 130 billion chat messages last year. That's more chat messages per day than people send on WhatsApp. And so we have a lot of content about people, and we can use that content, obviously only with their permission, to understand them better and then match them with other people in a better way. And that's a huge opportunity, and that's what we're doing. And kind of the Wingman is the embodiment of that, where we want that to be very easily accessible to everybody through a chat. We recently launched a product called A-List, which I'm super excited about because it takes all these messages in your inbox, and people have like hundreds of messages in their inbox over time. And understands those messages and then creates a short list of people that we think are your best connections. And you are able to sort through them. You get summaries of what the conversations were about, any of the media that was shared between the two people, and then you can re-engage those folks, because oftentimes people have conversations they kind of forgot about in their inbox that we then bring back. So that's an example of the kind of features the Wingman will offer over time, because one of the most asked feature inside Wingman today is show me more people like this.
Right.
But most likely you actually already have people like this in your chats. You just forgot about them. And we want to bring those back.
And so this is all AI that you're developing in-house.
Yes.
Is that going to make the difference between dating apps that work and the ones that don't?
Yeah, I mean, I think in general for incumbents, let's say, that have a lot of data, they have a huge advantage with AI because right now AI is really good with really good data, and incumbents have the data. Obviously, again, you need to have permission from users to use it. We actually went out and sought that permission, and we had a very high take rate on that. Unfortunately, I think most companies are not appreciating that, and they don't understand that this platform shift is actually very incumbent friendly and don't want to do the investments in AI. So my view was we actually need to invest in it very aggressively from the start and make it a huge benefit to Grindr, and so we're basically aiming to be an AI native company. We've had a chance to rebuild the team dramatically since I've been there. About 85% of people joined since I joined Grindr, and a lot of them are very AI forward people on purpose, because that's what we want to be doing.
So it won't necessarily lead to job losses.
I don't think so, because Grindr is growing dramatically, right? And so we would have needed a lot more people. We're a very nimble company, 154 employees, I believe, right now, in total for, on track to do over $400 million in revenue for the year. And so I think we'll need more people regardless as we scale, but I think each person is going to be way more efficient than they ever were before.
George, how do you address safety? Because I know there's still, safety concerns.
Absolutely. Safety and privacy are really critical on Grindr. Our users probably have a lot more privacy needs than most, given just how gay people are treated around the world. And so we are very privacy forward. We don't require you to have a profile picture, for example, to have a profile, because a lot of people can't have a profile picture for many reasons. I mean, in some countries they could be killed if they had a profile picture. And so we're very privacy forward. We work really hard to protect the data. And then we have a lot of algorithmic work happening inside the app, as well as human as kind of looking over that to ensure that bad actors are not in the app, to ensure that bad behaviors are protected, because we do want this to be a community. And frankly, our users want that, and our users really support it. Like, self-reporting of bad behavior on Grindr is way higher than most comparable products, because people really care about the community and want it to be protected and treated well.
So interesting. George, thank you so much for joining us today. That was the Grindr Chief Executive, George Arison. Now, to some other stories making news, and China's Xiaomi is unveiling its first electric SUV today. Now, the YU7 is billed as a direct competitor to Tesla's Model Y, with entry-level models expected to be cheaper. Xiaomi's shares have surged more than 60% this year, with the company now worth more than BYD, the leader in Chinese EVs. And Mars's $36 billion bid for Pringle chips maker Kellanova faces a potential setback. That's after the EU opened a probe over concerns that the largest packaged food deal in almost a decade could thwart competition. Well, watchdogs will examine how Mars might increase its bargaining power in talks with retailers. Regulators set an initial deadline of October 31st to decide whether to approve the deal. And the chief executive of Worldline has blamed an orchestrated media campaign for the firm's precipitous share decline in an effort to dig the company out of its current crisis. Now, in a call with analysts, he said the French payment processor had been attacked by the media. A series of articles had accused Worldline of covering up fraud by some customers, which he denies. And finally, NVIDIA has reclaimed its spot as the world's largest stock, overtaking Microsoft on bullish comments from the chief executive Jensen Huang at a shareholder meeting. Our Charlie Wells is here with an update. Hi, Charlie. So how sustainable is NVIDIA's market rally?
Francine, that's a great question. And the theme today really is about competition. You are seeing Microsoft and NVIDIA really neck and neck, but NVIDIA reclaiming that top spot as far as market cap. Now, if you want to think about that sustainability issue, this is a question that a lot of investors have. How much momentum does this AI story have? If you take a look at the analyst recommendations for that stock, you can get a sense here. And this is on the back, not just of those positive comments from Wang, but also a sense that we're getting that there really are legs here to this AI play. You are seeing a significant amount of spend coming from some of the largest tech companies as we've digested their earnings over the past week, from Microsoft, from Meta, from Apple, and from Amazon. You really are seeing that AI spend helping to boost NVIDIA and helping to give it that top spot as far as market cap.
Charlie, Micron also reporting results. What's the market reaction?
So here again, I'm talking about competition, but in this case, it is a company that in some ways is competing against itself. Micron really has been the darling chip maker of Wall Street over the course of this year. If you look at that Philadelphia Semiconductor Index, they are the top performer, up 51%. But those high expectations really sort of hurt them in the market yesterday. They delivered an earnings report that really beat almost across the board, but analysts and investors really wanted to see more on this issue of high bandwidth memory. That is an issue that is so important for AI. If you look at some of the commentary that we got from their CEO, he was asked significantly over and over again in that earnings call about that high bandwidth memory, and analysts and investors just did not like what they heard as far as the growth potential for that issue.
And finally, Charlie, Nike earnings also coming up later today. What are analysts looking out for?
Nike really trying to develop more of, a competitive edge here against Adidas. Over the past few years, they've really struggled there against one of their competitors. And one of the issues that investors are really going to be looking out for today is how Nike can launch and kind of, refresh some of their products. That is an issue that they've really been struggling with, the issue of innovation. And we're starting to get an answer to that. We are seeing a product that Nike has announced that they will be launching. It's coming out. It's really gaining a lot of traction on social media in sort of an unexpected way. It is called the Snowfer, and it is kind of a sneaker loafer gaining a lot of traction with followers on social media. Some on the retail market willing to pay as much as $500 for this item. I don't know that I'd be the first person to do this, but I don't really set trends in footwear.
I mean, I kind of could get behind it. The question is, do you put a sock or do you not put a sock, Charlie? It feels like it's already like an inbuilt sock, right?
It feels like that. It feels like that's the way to make this fashionable, Francine, which you do very well.
Well, I'm not sure about that, but Charlie could see you a very nice crisp suit and then the new Snowfers. Charlie Wells there with the very latest on a little bit of fashion wear, but also a lot of tech. Coming up, what does Trump's criticism of ESG mean for the future of sustainable investing? We'll discuss that next with Tukamuna from JP Morgan. That's next, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Welcome back, everyone. Now, shares of companies linked to New York City real estate fell after Zoran Mamdani's shock win against Andrew Cuomo in the first round of voting in the Democratic primary for mayor of New York. Now, Mamdani has promised a rent freeze in the city, as well as free childcare and cheaper groceries in government-owned shops. much of it financed by tax rises on the rich. Well, the former New York City Mayor Michael Bloomberg, the majority owner of the parent company of Bloomberg News, endorsed and contributed to the Cuomo campaign. Now, for a roundup of what this means going forward for New York, but also the two parties in the U.S., let's bring in Stephanie Baker, our senior writer. Stephanie, I've been wanting to speak to you, all week, actually, since this win to try and figure out what it means. I mean, suddenly are we going to see, first of all, does this translate nationwide, or is it really solely New York? And could we see an AOC president candidate for the Democrats?
I think it does resonate nationally for sure. I think it exposes the central fault line running through the Democratic Party right now between the old guard of moderate Democrats backed by big money using traditional legacy media and the new wave of younger progressive Democrats that are exploiting new media, social media, Instagram, YouTube, podcasts, and are proposing really a more progressive left-wing agenda. I mean, Mamdani is an incredibly charismatic figure, and he was able to beat the scion of New York State's leading political dynasty, the Cuomo family. And I do think it will, give wind in the sails of the younger Democrats who are trying to upseat and revive the Democratic Party, arguing that they have been asleep at the wheel and that they really need to embrace a new, energetic, new agenda.
And Stephanie, of course, there's the EU Leader Summit. I mean, are we going to see tougher sanctions on Russia?
They're expected to approve this new package of sanctions, but of course, Hungary and Slovakia are saying that they are going to hold up the sanctions because they are opposed to this EU plan to phase out the import of Russian fossil fuels by 2027. Hungary and Slovakia are very dependent on Russian energy still, and they have vowed to veto this package of sanctions because of that phase out. Now, the phase out, they're not really able to veto the phase out, but they can veto this renewal of this 18th package of sanctions. And I think that's what they're going to try to do, saying we want guarantees. We're going to be financially compensated for any fallout from that phase out in 2027.
Stephanie, thank you so much. Stephanie Baker, they're our senior writer, and of course we'll be watching the EU Leader Summit very closely. Now, the Trump administration has been quick to criticize the ESG investing and withdraw from climate commitments. Nevertheless, European pension funds continue to enforce ESG mandates. Well, joining us now to discuss the future of the green economy is Truco Muna, Global Head of Sustainable Solutions and EMEA Head of Green Economy Investment Banking at JP Morgan. And he's here also for our Global Sustainability Business Forum. So thank you, Truco, for joining us. Now, first of all, look, President Trump has made it pretty clear that he's no fan of the green transition. Does it really set the U.S. back relative to China and Europe?
Well, I mean, if you look at energy transition investment in 2024, 39% of it was in mainland China, around 22% across UK and Europe, and then, of course, the US behind that, 16.2% or thereabouts. So in that sense, not continuing to help boost the sector may potentially set the US a bit further back. But when you look at the sustainable finance landscape more generally, there is this question, does the way the US go, is that the way for the rest of the world? And that is not necessarily the case because the US didn't dominate in this space in the first instance. And if you look at public sustainable AUM, it's at about $3.2 trillion right now, which is, higher than any point in that kind of sustainable finance boost we saw immediately after COVID. And around 85% of that AUM is here in Europe. And so and that, to be honest, has been, Europe has dominated. So that's been the case for a while. So what happens in the US does not necessarily determine the way of the world. But in some senses, this debate's moved on.
But it's also, could you see private capital actually in the U.S. that is going to the green transition without outwardly saying that it's going to the green transition or ESG causes?
Well, on the private capital space, we've seen around $32 billion worth of fund launches this year. EQT did a big infrastructure-orientated fund launch, $23 billion. But also Blackstone as well, with its $3.2 trillion and $3.2 billion fund in the green infra space as well. So there's plenty of activity there. mainly revolving around electrified transport, renewables, and low-carbon energy solutions. And on the public side, I think what we're beginning to see here is a degree, there are signs of green shoots, if I put it like that, after a very tricky time for green economy stocks since the end of 2022. And we've actually just seen, and look, this is a short-term signal, but in the last month, the eco index of green economy stocks has actually outperformed the S&P 500 and also the NASDAQ. But hey, look, for our clients, corporate clients, this is, and for the bank, this is a big commercial opportunity. Jamie Dimon, our CEO, is being very clear publicly. We want to be the bank of choice for clients seeking energy transition-related advisory and financing. We actually, as a bank, made nearly $1 billion in revenue from green transactions and green clients last year. So this is very much an area of opportunity, not necessarily needing to be a problem.
When you look at some of the key takeaways on the Big Beautiful Bill, I mean, how difficult is it to, I guess, assess the impact on America's ability to participate in the green transition?
I think it's difficult at the moment because there's this big question about what elements in the IRA bill, the Inflation Reduction Act, what elements of that survive and what elements fall. But in some senses, I think the debate's moving from whether you're for or against investments in the energy transition or whether you believe that there is a climate crisis to where do you get your energy. Right. Energy abundance is something that, if you like, unites both sides of the debate. And we don't have enough of it. We have growing energy demand from electrification, AI, the higher temperatures lead to the consumption of more energy. And then, of course, what's happening in the emerging markets. 80% of the growth in energy demand last year came from emerging markets. And so where you can get enough energy to meet the demand is the big issue. And actually, secondly, I think we are seeing the interplay between geopolitics and this issue of energy becoming far more pronounced as we go into the second half of 2025.
So if you change the lens and look at it through a self-sufficiency energy lens, then I guess it changes the complex everything in terms of investment, in terms of capital raising and deployment of where the money goes to.
Completely. I mean, look, if you look historically in the 18th and the 19th century, the UK used its prowess across coal partly to fuel its position as the leader in the first industrial revolution. In the 20th and going into the 21st century, obviously you saw the Middle East and its supply of oil being something that gave it a strategic edge. Going into this new and green industrial revolution, China is using its early investments in different green tech and infrastructure to give itself a real position. And nowhere is that more acute than when we look across critical minerals and rare earths, where China basically controls 70% of the production of critical minerals, 90% of the processing, and we have seen how they've used that and applied export restrictions in the context of the tariff tensions and the trade war that's ongoing at the moment. And to be frank, I don't think that this has been properly priced in by the market, the exposure of corporates to potential critical mineral supply chain issues, because the supply is quite concentrated in just a few countries, DRC, China, Indonesia, and so forth. And yet, a withdrawal of those critical minerals for many big Western companies across Europe and the US could potentially pose an existential threat. Now, we haven't seen that feed through into prices yet. People have been stockpiling these critical minerals.
At the margin, sometimes it has. Certain days, right, where there was more friction between, for example, China and the US.
But we're really seeing, and if you look at lithium, we have seen a 30% growth in lithium demand in 2024 relative to around 10% through the 2010s. So this is coming down the line, not being properly priced in, I think, by the market yet, but is going to become an increasing risk. And with the concentration of supply in just a few countries, the potential impact of a supply shock when something like that occurs will be quite great.
Tugga, thank you so much for that. Tugga Munandar, Global Head of the Sustainable Solutions at JP Morgan. We also have the Sustainable Business Summit here at Bloomberg all day, so we'll be on stage very shortly. And you can follow all of that on Live Go on the Bloomberg terminal and on social media. Up next, Bloomberg Brief. Of course, I'll talk about Treasuries, dollar, and Jay Powell. This is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask Interesting questions.
Bloomberg Television. Top experts, great questions.
We'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of guardrails may be set up just yet. Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Thursday. A challenge to Powell. President Trump readies his list of picks to replace the Fed chair. Reclaiming the throne, NVIDIA hits a record high, overtaking Microsoft as the most valuable company in the world. And far from a deal, House and Senate Republicans still at odds on SALT deductions for high tax states. The move yesterday, you have to go up 4 decimal points to see what the S&P 500 did yesterday. That is the smallest move in either direction since 2017. Thank you to Deutsche Bank for that statistic. Even so, the NASDAQ hit another record high. NVIDIA hits a record high. You get gains again this morning, up 1/3% for the NASDAQ, 0.5% for the NASDAQ, rather, 1/3 for the S&P 500. The bond market, perhaps more interesting this morning. It is a clear rally on the front end with that journal report that Trump may announce a pick for Fed chair sooner rather than later. He tells us he's got 34 names on that list. You see 2-year yields come down 1 basis point at the lowest since May 1st. 10-year yields, similar dynamic. They're down about 1 basis point. All of that also sending the dollar much weaker, the weakest versus the euro since 2021. Let's get you some stocks to watch this morning with what's moving in the pre-market is Joe Easton. Hey, Joe.
Hey, Danny. So it's all about the chip stocks today and the pre-market movers. We got a trio of chip stocks to bring you. Firstly, Micron beating expectations last night, selling a lot of their chips into the AI space. The earnings much better than expected, and the stock extending its recent gains this morning. We're up 2.6% on that one. But then the real star of the show, NVIDIA, of course, as Danny mentioned a moment ago, hit a record high yesterday, set to open at another record high today. The stock up 60% since the lows in April. Now, all of that boost really coming from those big companies, Microsoft, Google, that it sells those chips into. So that stock, NVIDIA, higher again, around 1% today. But going the other way, ASML, a Dutch-listed firm, of course, but also US ADRs, hit today by downgraded Jefferies, which says it has significant concerns about the impact of US regulations restricting exports to China. And as usual, check out the Before the Bell opening wrap on the terminal for a fantastic wrap-up of all these news and more, Danny.
Joe, thank you so much, and we will see you later in the hour. Also in this hour, we'll speak with Max Kettner of HSBC on this risk-on environment, and Terry Wiseman of Macquarie on possible early announcement of a new Fed chair. Now, risk assets remaining resilient despite successive geopolitical shocks. Max Kettner, chief multi-asset strategist at HSBC, writes, "We argued for a risk-on stance over the summer. This hasn't been met with a lot of agreement in the last 2 weeks, but we think the biggest risk to our view is that we're not bullish enough." Joining us now is the bull himself, Max Kettner of HSBC. Max, really great to see you. So what are the upside risks to your outlook at this moment?
Yeah, good morning, Danny. I think actually what we're facing right now is this classic wall of worry. If you had to write a textbook on what wall of worries is, it is right now. We obviously had just geopolitics that markets were facing, you know, still fretting around whether that ceasefire holds or not. We obviously have the 9th of July deadline on tariffs. We then had the 12th of August deadline. Even if that passes, I guess people will still be fretting around perhaps the possibility of some sort of possibility of a failed bond auction in treasuries. Then, of course, the narrative now for the second half, a lot that we've been hearing, particularly from macro guys, from economists as well, fine, second quarter US growth is okay, but none of that is genuine strength. It's only just front loading. In fact, under the hood, the US consumer will feel the strain, and by the second half, maybe third, maybe fourth quarter, we're going to start to see the reversal of those front-loading effects. So to me, actually one of the catalysts, one of the upside catalysts is just climbing this perennial wall of worries. It reminds me a lot about the beginning of 2023, when also people were very, very bearish. Positioning is another catalyst. In fact, when we look at our measures of long-only positioning, people, long-only investors in particular, are as bearish on high-yield credit as they've been in 2022 and 2023. We look at, you know, you just were talking about new all-time highs in the NASDAQ, and despite that, all of our shorter-term positioning stuff is still sending a buy signal. So there's a lot, I think, to go for, a lot of sort of technical factors, but also very low growth expectations, very low earnings expectations. Look at Q2, the Q2 reporting season. Actually, consensus is saying earnings are going to drop quarter on quarter, despite the second quarter from a top-down perspective being really, really strong. So I do think there's a lot to go for, and I really, really think investors are underestimating heavily how much we could see a melt up and a squeeze into the summer months now.
Is it all fundamental at this point, Max, or is something to these new highs or close to new highs that's been driving us? Because to your point, we were all worrying about a war. We were all worrying about all these things, but the equity market wasn't paying attention to it. So what type of market regime are we in right now?
I think it's actually pretty close to Goldilocks regime, at least when we look at some of our data where, you know, we look at different kinds of regimes. It's very, very close to classic Goldilocks regimes with the yields a bit lower, weaker dollar, carry assets in vogue, high yield credit in vogue. In fact, we're almost maximum overweight high yield credit at this point and still sticking to that. You know, I think in total, when we look at the arguments around, is this purely technical driven? Is this purely flow driven because fundamentals are still really bad? I don't believe that at all. In fact, you know, one of the things that kept us a bit bearish in March and April was, well, if there's ever been an incentive for companies to cut or pull their guidance, it's in the Q1 reporting season. And the reality was that, number one, companies were actually pretty happy to extend their guidance, to keep their guidance. And in fact, when we look at earnings beat rate, we look at earnings surprise factor, so how much on average companies beat, it was significantly above where it was pre-COVID on average. So very, very clearly what we are seeing is the fundamentals, the earnings, the plain vanilla, the numbers are actually looking really, really, really strong. And despite that, I think people are just way too much focusing on the news flow, on the politics, on the geopolitics, on the next sort of element in the wall of worries, instead of just plain vanilla looking at the numbers, which particularly from a bottom-up perspective and particularly in the US, look really, really solid.
So we were all distracted, but really since late May 21st, we've seen equities grind higher. And at the same time, Max, you've seen yields come down. It is back to that classic environment of stock-bond correlation. If that is indeed holding, we are back to lower yields, stocks rally. Doesn't that mean there is a threat that if yields do turn around, the correlation sticks and you could get some significant pressure in this equity market?
Absolutely. I think 100% correct. I don't think we're quite at the point yet where I want to be shorting treasuries, sort of be max short stance on treasuries. Not quite yet. I think that probably comes towards the end of July, beginning of August. In fact, what we could be seeing in the next few weeks is this sort of seasonally driven increase in jobless claims. We've already seen that in some states. In California, we've seen it in Minnesota, where some of the rules have been changed around that. So the next 4 or 5 weeks, we could be seeing a bit of an upside potential on jobless claims, and that, of course, would then mean a bit more downside pressure, perhaps on yields. But in order for yields really to rise so strongly that it puts pressure on credit spreads, on emerging markets, on equities, on valuations across the asset classes, we really need to get to the sort of 4.7% area. So we've got this model, this what we call danger zone model. So this, if you like, Tom Cruise kind of model. Sadly, I'm not looking that good, but you know, that's at least what we call it. So that model tells us right now is a 4.7% where really valuations start to take a hit. We're almost 50 basis points away from that, right? Like a good 45 basis points away from that on the 10-year. So until then, you know, I think it's pretty full on, right? If we trade back to 450, 460, so what? Even if the big beautiful bill passes, even in its current form, and we back up another 20, 30 basis points on the upside on the long end, I think given how much we've rallied in bonds in the last couple of weeks, that actually doesn't pose a threat to equities and to valuations really across the asset classes yet. Needs to be much closer to 5%.
Yeah, and just all the data you're talking about coming up, Max, it does underscore that you can throw quite a lot at this economy before it falters, but you've mentioned some of the trickiness of the summer and specifically the start of July. July 4th, one big beautiful bill. July 9th, reciprocal tariffs come due. July 15th, you get a CPI report. I know that you are bullish right now and the market continues to climb those events and that wall of worry. But does it put a ceiling on just how risk on you can be given what we're likely to get in the summer months when usually everybody is away from their desk at a beach somewhere?
I don't think it does. Let's look at the last couple of weeks. Let's look at the last week and a half, 2 weeks. Geopolitics, the market was barely down. The S&P was barely down. We had some sort of solution around it, and we've rallied. We've rallied almost 3% now. So very clearly, we have an asymmetry to the upside. Why? Because positioning is still so subdued. It's not only long-only positioning. In fact, when we look at systematic positioning, that still is somewhere between 25th and 30th percentile on our estimates. So very clearly, what we're seeing is, if we don't see any further bad news, that already is enough of a catalyst for us to rally. And number two, I think now in July and August, when we get the Q2 reporting season, let's be honest, what we could be seeing is we're going to focus on the 9th of July, maybe on the CPI report, maybe then on the 12th of August, the US-China deadline. And instead of that, what we should be focusing on is the reporting season. Let's not forget that the dollar just went down 10%, and that is a massive boost for particularly the mega caps. The 7 mega caps, they made 60% of their money last year outside of the US. So the weaker dollar is a massive boon for them. So that really tells us, I think we're focusing on the wrong kind of news flow right now, whereas in the next 2 weeks, I think there genuinely, again, as I said, I think there is a risk for a melt-up driven by the mega caps, just how much those earnings could be surprising to the upside.
Yeah, don't make this same mistake again. And we're not in the danger zone. Max, thank you so much. The very own Tom Cruise of HSBC, Max Kettner there, joining us this morning. Thank you for your time. All right, let's get you some other top stories trending on the terminal this morning. The Federal Reserve has released plans to relax a key rule that would reduce capital requirements for big banks. It allows the banks to hold more treasuries and act as intermediaries in the $29 trillion market. Bloomberg reported on the potential change last week. Japan's chief trade negotiator says the country cannot accept the U.S.'s 25% tariff on cars. He added that Japan's automakers produce far more cars in the U.S. than they export to America. He spoke to reporters before heading to Washington for the 7th round of trade negotiations. Meanwhile, Shell says it has no intentions of making an offer to take over rival BP, refuting an earlier report that the two energy giants were in active merger talks. The announcement follows speculation after years of poor performance and rising activist pressure at BP. Back in May, Bloomberg reported that Shell was studying the merits of a deal. Coming up, preparing to replace Powell, President Trump has made it clear he will replace the Fed chair, but he could name a successor sooner than expected. We have the details for you next on your brief.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
The only thing that's gone up actually is interest rates, because we have a Federal Reserve Chairman that is playing politics. Always too late, a little slow, and I'm not happy with him. I believe he's making a mistake by not lowering interest rates, and I think as well as we're doing, we'd do much better.
You're not supposed to criticize the Fed. You're supposed to let him do his own thing, but I know much more than he does about interest rates, believe me.
The Bank of England cut, China cut, everybody's cutting but him. We can't get this guy to do it. And the fake news is saying, oh, if you fired him, it would be so bad. It would be so bad. I don't know why it would be so bad. I know within 3 or 4 people who are going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible.
He's making a list. President Trump ramping up the pressure on who Fed Chair Powell should be replaced by. The Wall Street Journal reporting that he might announce a replacement by September or October. Joining us now is Bloomberg's Suzanne Lynch. Suzanne, what do we know so far from the various reportings about how this might take place?
Well, as we heard there just yesterday, Donald Trump doubled down on his criticism of Jerome Powell at that press conference following the NATO summit. And we're now hearing and reading reports that maybe over the summer, that Donald Trump may name a successor. Now, obviously, Powell has 11 months left to run, and the idea of naming someone much earlier than would be usual opens up questions, about what kind of maybe influence this pick might have, a kind of a backseat driver kind of situation, if you like. Obviously, Donald Trump is not happy with the job Jerome Powell is doing. He's criticised him on many occasions and has called on him to cut rates, as we know, a lot quicker than he has.
Elsewhere, Suzanne, in Washington, D.C., the One Big Beautiful Bill still making its way through Congress. There seems to be a split idea in how close or far away they are from an agreement. John Thune seemed pretty enthusiastic that they could get it done by the deadline. But then we had Representative Nick LaLota saying that they're far from a deal on the SALT limit. Suzanne, where do the tensions still exist? How far does it actually seem we are?
Well, it is significant that Republicans in the Senate met with the Treasury Secretary, Scott Bessent. That would imply perhaps things are coming to endgame. The Senate hopes to get this on the floor by Friday. That is the new aim. Let's see if that happens. But as you mentioned there, the SALT issue seems to be the problem. Again, Bessent met with some of the key lawmakers here from states like New York, New Jersey, California, which have concerns about this. The Senate version of the bill is keeping that $10,000 cap that existed. The House version of the bill had that $40,000. So this seems to be a key sticking point, but Republicans are signaling that they're hopeful that by this weekend there will be something on the floor to vote on.
Well, Bessent has really been urging Congress come up with something to keep the full faith and credit of the United States. He's been talking about extending the debt limit special measures period through July 24th. Suzanne, what difference would that make?
Yeah, I mean, look, there's a lot of uncertainty here in the big picture. Analysts, as we reported in Bloomberg, think that, they'll be able to meet those payment requirements till August. But after that, a lot more uncertainty. So there is a lot of concern about the broader situation here. Not only do we have crunch time with these tax talks, this tax bill decision, we've also got the looming July 9th deadline for tariffs. And we know that discussions are underway between the US and its big trading partners, the EU, Japan, as we just heard earlier. So all these issues, I think, are feeding into investor concern about these issues coming up in the next few months.
Yeah, a lot of deadlines coming due. Suzanne, thank you so much. We'll catch up with you later in the hour. Suzanne Lynch in Brussels. Now, over at the NATO summit, President Trump said the U.S. would hold a meeting with Iran next week. He doubted that a diplomatic agreement on the nuclear program was needed after the damage that the U.S. had inflicted. For more on the latest, Bloomberg opinion columnist Mark Champion joins us now. Mark, how does that color potential talks if it is a president who is cast doubt on the need for diplomacy given the damage?
Yeah, I mean, it's a very good question. The strikes have definitely changed things, but they have not done what the president says, which is to, eliminate the problem. What they have done is to sort of reduce the urgency of getting a deal. If you're not sitting there, saying that this is the Iranians are imminently about to produce a bomb, and if we don't get a deal, within so many days, then we'll bomb them. Then, the urgency to get a deal very quickly just isn't there. So I think what if you listen to what else the administration is saying, that they're now talking about how this could trigger a deal in Gaza, and then from that, a widening of the Abraham Accords to include more countries. They're clearly thinking in terms of getting something broader. And they don't actually need a nuclear deal immediately in order to do that, the deal with Iran. So it's the ceasefire that will allow these other things to happen. That's in principle if the Israelis play ball. Having said all that, ultimately, the bombing isn't really worth anything if there isn't a deal that ensures that in the longer term, the Iranians don't just produce a bomb.
Right. And Mark, it takes some time to get a damage assessment of what exactly happened and the damage done. There's been various remarks, and again, it's still very early. How does the outcome of that also impact the talks? If it does seem like Iran can restart their nuclear arsenal sooner, does it put that urgency back into the conversation?
Well, yes. If there's, if it becomes clear that, really not a lot of damage was done, and that the Iranians could very quickly, they've retained the enriched fuel stocks that they already had, and they have enough cascades to enrich that to weapons grade, and to do that quickly. And they still have some facilities that intelligence agencies believe are developing warheads to put on missiles. If all those things are true, that would mean that the bombing actually achieved very little, and the urgency would return. But within all that we're seeing, it does sort of seem unlikely that some significant damage wasn't done. Just as it's unlikely that it's finished the program altogether.
Mark, thank you so much for that. That is Mark Champion of Bloomberg Opinion. Coming up, the battle of the Titans. Blue Origin owner Jeff Bezos could be a key beneficiary of Trump's feud with Musk. We've got what's in your morning papers coming up next.
Bloomberg launches our inaugural 25 African Startups to Watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We're integrated in every refrigerator, a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Let's take a look at what's on the front pages this morning. First up on the Wall Street Journal, the feud between President Trump and Elon Musk producing a potential winner, Jeff Bezos. The Blue Origin founder has spoken to President Trump at least twice this month. Blue Origin CEO Dave Limp also met with the president's chief of staff at the White House. Sources say some of the conversations involved appealing for more government contracts. Next up, the Washington Post leading with the White House planning to limit sharing classified intelligence with Congress. It follows leaks of an earlier assessment that undermined President Trump's claims on Iranian nuclear sites. And on the FT, Wall Street financiers are racing to rally behind an anyone but Mamdani candidate for New York City mayor. Within hours of the 33-year-old Democrats' win, hedge fund investors and private equity titans huddled to find the best way to back a centrist challenger. Michael Bloomberg, the majority owner of the parent company of Bloomberg News, endorsed and contributed to Cuomo's campaign. By the way, Dan Loeb on X calling it the hot commie summer. So that's something for you. Coming up, President Trump ramping up pressure on Fed Chair Powell. We'll catch up with Macquarie's Terry Wiseman coming up next. Stay with us on your brief.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. there has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Thursday. A challenge to Powell. President Trump readies his list of picks to replace the Fed chair. Reclaiming the throne, NVIDIA hits a record high, overtaking Microsoft as the most valuable company in the world. And far from a deal, House and Senate Republicans are still at odds on SALT deductions for high-tax states. Well, the move yesterday in this equity market, you have to go out 4 decimal points in order to see the move. It was the smallest since 2017. Thank you to Deutsche Bank for that statistic. But we continue the rally today. The S&P 500 less than 1% away from an all-time high. The NASDAQ, it is already there alongside NVIDIA. When it comes to this bond market, it is a rally, a noticeable one yesterday after that journal story that the president might announce his Fed pick sooner rather than later. Yields down by a basis point on the front end, while the euro versus the dollar strengthens by 0.5%. Let's look at some of the stocks to watch this morning. Back with us is Joe Easton. Good morning, Joe.
Hey, Danny. So it's all about the chip stocks in the pre-market so far this morning. Firstly, Micron beating expectations after the close of trading yesterday in New York. So that stock gaining around 2.3% at the moment. A lot of it is due to the exposure to AI and the chips that they are selling into that space. And Micron set to open higher today. But the real star of the show, of course, is NVIDIA after that record high yesterday. Set to open again at another record high, already up 60% since the April low, overtaking Microsoft as the biggest company, as Danny explained a moment ago. So that one set to open at yet another record. Then finally going the other way, ASML. This one hit by a downgrade over at Jefferies, which warns of significant worries about the restrictions on US chip sales to China. So they cut the stock to hold. They've had a buy on around 5-year basis, but they now come down to hold. All about the chips. I tried to find a stock outside of the chip sector, but I couldn't manage, unfortunately. All about the chips today. ASML edging lower in the pre-market today, Danny.
Joe, that is totally fine. Excellent work, as always, Joe Easton there. Thank you. Now, the Wall Street Journal reporting, as we've been talking about this morning, that President Trump is considering an early announcement to his pick for the Fed chair to succeed Powell. Yields on the front end fell to the lowest since the start of May on that story, as the dollar fell to the weakest versus the euro since September 2021. Joining us now is Terry Wiseman, Global FX and Rate Strategist at Macquarie. Terry, great to see you this morning. Thanks for coming in. How would an early announcement, September, October, whenever it would be, change the dynamic and how the markets react to what we're getting out of the FOMC?
Well, look, the president is clearly trying to interject himself into monetary policy decision-making. Is that much of a surprise? No, not really. Through his social media platform, through his other public comments over many years, he has tried to interject himself into policymaking at the Fed. I think what's different now, however, is that he actually wants a person or a personage to come in and serve as that shadow Fed chair, that shadow FOMC, maybe so that he doesn't have to be on social media all the time tweeting about the Fed's decision, and he can leave that to someone else who has experience, who might be able to more articulately, if I could use that word, define what the Fed should be doing. Trump is not very good at that. He says that the Fed is not doing a good job, but he doesn't always tell you what exactly should the Fed be doing. Maybe with the appointment of someone, or the designation is a better word, obviously, of someone who could shadow the Fed for the next few months until such time as Chairman Jay Powell's term ends as chair, Trump will actually be doing effectively a better job of what he already wants to do, which is to inform and guide and interject into policy to some extent. Look, is this completely unusual? No. There have been other countries that have something called a shadow board or a shadow monetary policy committee. They have one in the UK. It's a group of academics who are, appoint themselves independently. They're not appointed by the Bank of England, they're not appointed by the Prime Minister, but they do shadow and talk about what the MPC at the Bank of England does. The difference here, however, is that in the US, what Trump is trying to do is put an official stamp on this shadowness or this shadow chairman, whereas in other countries, when you have diversity of opinions in the public space and you have things like groups of people who challenge the central bank, it's not done on an official basis. I think the difference now is that Trump is trying to do this on a semi-official or official basis with this designation of someone.
If you do get that, it's semi-official, but does it actually do anything to influence Powell?
Well, I think it does, in the sense that it provides at least some intellectual articulation or construct around why the Fed needs to do something else. If you read the minutes, if you read the statements effectively, what you're getting is the opinion of the majority. Are there official channels for the minority to say something? Yes, there is. An independent, a regional bank president, for example, can give a speech that is at variance with what the FOMC does. But there isn't a collective body. There isn't a body of opinion that expresses holistically and coherently the view of the minority. Do we need that? Not necessarily, but I think this is what effectively Trump is trying to establish.
If you do get a Fed chair come his replacement next May, that is an outlier. The convention at the Fed is that you listen to the Fed chair, that they really set the tone for policy. But again, it is only convention that sets that. If it is an outlier, could that be tested? Do you think that this is a committee that would be pushing back?
Yeah, that's a great question. I think what you're trying to say is, what if the president appoints someone to be Fed chair, but that person's view is not in line with the majority of the FOMC? I think that's a problem. The Fed has a tradition of trying, at least, to build consensus around its decisions, right? If the chairman wants to do something that's an outlier relative to what a majority or near majority of the FOMC wants to do, they try to converge in the middle and try to at least convey that there's a consensus with regard to the decision. It doesn't always work. There are some dissenters, but I think the idea is to try to generate consensus. If you have someone who's an outlier and who doesn't care for consensus, I think you can have these divisions of opinion at the Fed and within the FOMC come out more into the open, and it'll be seen by the ambiguity, let's say, of the things that they say in the statement, the divergence of opinions in the minutes. You can see that as a result of someone who's an outlier being the chairman.
So should we get this announcement, does it just argue for increased curve steepening? It's certainly been the initial reaction to this.
Absolutely. And I should say that the reason that the yields in the front end of the curve have come down recently is not just because the president has been talking about designating someone to be the next Fed chair. It's also because Jay Powell himself has moved away from the strict neutrality around the policy outlook that he conveyed back in May. He, too, has been a little bit more accommodative, if you will, or acclimating to the idea that the Fed should cut. You see it in his commentary about the prospect that by the time the July and August data roll around, we may be cutting, assuming inflation is not, shockingly high. So I think the move is already happening at the Fed, and I think the data has moved them in that direction. I think what we're seeing here is a president who's simply just too impatient to wait, potentially until September, but also a president who wants to make his mark in a way that is more official, if you will, than the use of social media and the use of commentary, which we know Trump is not the most articulate person when it comes to trying to offer different opinions.
But it seems like having someone as a punching bag at the Fed is useful for him, though, that he can blame the woes of high debt costs, he can blame the woes of the economy to someone who's at the Fed. If he doesn't have that anymore, it feels like he loses kind of a key thing that he can, a key tool.
Absolutely, which is exactly why the president must be careful here, because if he appoints his own person, his mini-me in effect, to run the Fed, he won't have them as a punching bag anymore if they don't do what he does. And we've seen many examples in the past. I would actually put Jay Powell as an example, right? Someone who was appointed, a Republican who appointed to be the chair, and in the final analysis did not end up doing exactly what a Republican president wanted him to do. Trump runs that risk again if he appoints someone, in March to replace Jay Powell, only to find that that person has an independent streak and has only displayed an affinity to Trump's views until such time as he's appointed and has taken power at the Fed.
Well, Terry, as you noted, the move lower in yields started before this, maybe late May. Yields moved lower, equities went higher. The one thing that feels like it's been since the start of the year is the dollar.
Of course.
War, no war, economy good, economy bad, dollar weak. What stops this trend?
Look, we've been talking about the prospects for a weak dollar even before April 2 and before Liberation Day. There were plenty of things that were happening abroad, let alone in the U.S., that were militating in favor of a weaker dollar. We anticipated the change in government in Germany, for example, and the prospect that we'd see fiscal reform. There was important pro-growth policies potentially coming out of Canada. China was being stimulative. The BOJ in Japan was still on a normalization tack. So there were things militating in favor of a weak dollar, before April. And of course, then you had the shock of Liberation Day that reduced the brand name of the dollar even further, called into question the reserve currency status of the dollar because the U.S. was seen to be edging away from its global responsibilities. And now in the last few weeks, we have other things that are militating in favor of a weaker dollar. Obviously, the lack of integrity in Fed policymaking if Trump has his way, but also things happening in Europe that seem to be militating in favor of a weaker dollar, at least a stronger euro. So I don't think there's anything right now that stands in the way of a weaker dollar. I certainly don't see it on the horizon. If war breaks out again in the Middle East and there's a flight to safety and a flight to quality and some haven seeking on the part of investors, the dollar could strengthen again, as we saw when hostilities broke out. But barring that, there doesn't seem to be anything in the way of a weaker dollar right now.
Dollar's still weaker versus the euro this morning, more than 0.5% at a September 2021 low. Terry, thank you so much for joining. Brilliant as always, Terry Weissman of Macquarie, and you are watching Bloomberg Brief.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing. Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5. Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
The only thing that's gone up actually is interest rates. because we have a Federal Reserve Chairman that is playing politics. Always too late, a little slow, and I'm not happy with him. I believe he's making a mistake by not lowering interest rates, and I think as well as we're doing, we'd do much better. You're not supposed to criticize the Fed. You're supposed to let him do his own thing, but I know much more than he does about interest rates, believe me. The Bank of England cut, China cut, everybody's cutting but him. We can't get this guy to do it. And the fake news is saying, oh, if you fired him, it would be so bad. It would be so bad. I don't know why it would be so bad. I know within 3 or 4 people who are going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible.
President Trump is making his list for a potential new Fed chair. The Journal reporting that it could happen as soon as September or October. Back with us now is Bloomberg's Suzanne Lynch. Suzanne, we were just talking to Terry Wiseman of Macquarie about this and the possible market impacts. Does it seem like we will get something of a shadow Fed chair?
Yes, I mean, this idea that Trump may impose his own person, if you like, to try and steer policy or influence policy in some way from the back seat. Won't be in power, but will be there in the background. I mean, this is a reality that may happen if he goes ahead, as he seems to have confirmed there in that press conference yesterday that he would. He said specifically that 3 or 4 names he's considering. He has made it very clear that he's unhappy with the Fed chair. He wants him to be moving on interest rates. So we do, all the signs are that he is actively considering this and may well do so before the summer's out.
Meanwhile, in Washington, D.C., we're getting very close to the deadline for the One Big Beautiful Bill, just over a week away. How divided does it seem this Congress is on things like the SALT limit?
Yeah, I mean, this SALT limit, the state and local tax provision, is emerging as a key sticking point now as we reach end game on the Senate side. The Senate is hoping to get this bill to the floor to have a vote on Friday, but lawmakers, Republican lawmakers from those high tax states like New York, New Jersey, California, they have been expressing their concern. So let's see if they're able to hammer something out to get this over the line. The Senate version of the bill and the House version differ on this issue. So this is emerging now as a key point as we enter what Trump hopes is the last few days on this. He is wanting to get that bill on his desk to sign by July 4th. So it's a key weekend and a key 48 hours coming up.
It's also key, that timeline, for when we get more trade deals, because, Suzanne, the NEC director Kevin Hassett has said that once the One Beautiful Bill passes, then they'll start to announce some trade deals. This coming from Reuters, that the India and U.S. are still in a deadlock of talks ahead of that deadline. You're there in Brussels. How does it look like even EU-U.S. negotiations are going for this trade deal?
Look, it's a huge issue for Europe. The EU, it's a market of 450 million people, and it's a huge trading partner of the United States. As we're talking here, EU leaders, all 27 prime ministers from the European Union countries are meeting here in Brussels. They've just come straight from that, and a lot of them have come straight from that NATO summit in The Hague. But the focus now, it has been on defence, is now on trade. We do expect these EU leaders privately to discuss strategy today. The European Commission President, Ursula von der Leyen, who's in charge, essentially, of EU trade policy, she's going to be meeting with leaders, she's going to be briefing with them, and more importantly, trying to listen to member states, to EU countries, about what strategy the EU should take here in negotiating with the US. They are very concerned about possibly, we have these 10% tariffs, but also those tariffs, those sectoral tariffs on aluminum and steel, on autos, and obviously on the pharma sector if those tariffs come. So we're really expecting discussions to intensify here over the next few days ahead of that July 9th deadline. And as I say, it's happening just across the road from me here in Brussels today, a big discussion on this.
Suzanne, we look forward to catching up with you with any announcements coming from that. Bloomberg's Suzanne Lynch, thank you for your time this morning. Now let's turn to tech. NVIDIA extending gains after closing at an all-time high. CEO Jensen Huang reassured investors at a shareholder meeting that demand for AI chips remains strong. Joining us now is Bloomberg Tech Europe anchor Tom McKenzie. Tom, it was an NVIDIA that was unloved to start the year, and the trend has been higher and higher ever since. What's been the reason behind this latest leg higher for NVIDIA?
Yes, since those lows of April, as you say, Danny, the stock is up, what, a little over 60%, and it's pushing higher pre-market today as well. Jensen Huang talking at that shareholder meeting and re-emphasizing for investors that growth, that demand for his GPUs, his AI accelerators, of course, is still there, saying we are still only in the very early innings when it comes to the build-out of infrastructure around this new computing world that he envisions. So there's that reassurance on the back of solid earnings, on the back of recommitments from the big hyperscalers, the Microsofts of the world, of course, the Amazons of the world, not in any way, in any sense, pulling back in terms of their spend around the data centers. You've got all the push around sovereign AI, of course, the commitments in the UAE, the commitments in the Middle East, and here in Europe as well, to build out those data centers, into which, of course, those GPUs from NVIDIA will play a crucial role. So it's that all that coming together to continue to give legs to this stock that back in April, of course, had been in the doldrums. Is up about 15% year to date, but the growth is there. And in terms of the multiples as well, interesting, if you look at it, 31.5 in terms of the multiples on a kind of 12-month earnings prospects. That compares to around 27 for the NASDAQ 100 for a stock, of course, that's expected to grow much quicker than most NASDAQ 100 listed companies. So in terms of valuation, it doesn't look too stretched at all. In terms of the long-only funds as well, this is interesting. Long-only funds have about 74% of them have exposure to NVIDIA. That compares to about 91% to Microsoft. So there's still a bit of a catch-up in terms of long-only funds and their exposure in terms of big tech to NVIDIA versus some of the other names in that basket. And for some, looking at that piece, that suggests there's more money to put to play. There's further upside for this stock, potentially.
Tom, quickly, it seems like however bullish we are about AI, something in the market surprises us that maybe we weren't bullish enough. Is that the case with Micron and their earnings?
They beat in the third quarter, they beat on earnings, they beat on sales, they beat on profit, they beat on revenue, and the fourth quarter estimates was a beat as well from Micron. This stock is up about 50% year to date, but what they didn't come out and is articulate gangbuster growth going forward. The growth is still going to be there. They emphasize this, executives. The scrutiny with Micron is on the HBM, or the high bandwidth memory chips, to which they have seen huge demand. They have to go and complement the GPUs that go into these data centers. They don't see any slowdown. It's just that what they predicted, what they forecast, wasn't smashing it out of the park like some expected in terms of investors. Morgan Stanley putting out a note and a response saying the biggest inflection in the cycle is now behind us. We see the valuation on Micron as demanding.
Tom, thank you so much. That is Bloomberg Tech Europe anchor Tom McKenzie. Let's turn now to consumer earnings. H&M shares jumping this morning in the European trade. The retailer reported better than expected profit, helped by tighter cost controls. Joining us now with the latest is Bloomberg's Charlie Wells. Charlie, what was the read from H&M?
Yeah, Danny, the read was positive, and the market this morning is really liking what it's hearing. And this seems, at least to some investors, like the sign of a turnaround that H&M has needed for a long time. This is a fast fashion retailer that has struggled to gain traction relative to a lot of its competitors. It is an arch rival of Inditex, that is the parent of Zara, and they've really struggled relative to Zara to try to kind of beat back some of the new competitive pressures that they faced in the space. They've had other headwinds as well. One of the issues in that fast fashion space is that margins are so thin, and something that kind of differentiates H&M from Zara is that H&M relies significantly more on suppliers from Asia. So some of those freight costs have gone up. That has eaten into the margins for H&M. I talked about a turnaround, and that is something that management has really been focused on at H&M. They really want to get their margin up to 10%. Now, we're seeing in some of these numbers coming out this morning, and I think this is what the market is liking, we're seeing cost controls, as you mentioned. That is something that could help margin. But another issue here really is revenue, and that is a little bit more challenging if you think about it. They've got to think about demand. They've got to think about that core brand and driving demand, and we're not seeing that quite as strong as we might want. So this could be positive sentiment today, but still that stock has been under pressure over the past few years.
Hey, Charlie, quickly here. We're also going to get Nike earnings, another company that might need to convince the market it can turn things around.
That's exactly right. So there's really going to be a focus today on how they can kind of refresh that product mix. We're getting a little bit of an answer from social media, at least for these sorts of products that might be taking off at Nike. One is the Snowfur, which is a little bit of an unexpected mix, but it's gaining a lot of traction online. Resale value at $500, even though these really are not from Nike on sale yet. So just a glimpse of how important social media it is and how Nike is trying to refresh that mix. This is a mix of a sneaker and a loafer. Let's see if that translates to earnings quite yet.
Yeah, I'm looking at them now. Not for me. Just going to say not for me. So
no,
weird.
Pass for
You're going to wear them into the
office,
Charlie? No?
No, not for me.
See, we can't see your feet. We don't know that you're not wearing snow furs right now. So we'll leave that to the audience's imagination. Charlie, thank you so much. Charlie Wells, you're watching Bloomberg Brief.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jumana Versace in Doha, Qatar, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Get you set up for your trading day. On deck, an exclusive interview with San Francisco Fed President Mary Daly. That's at 8:30 a.m. Eastern. We'll also get jobless claims, durable good orders. Those also come out at 8:30. And we're going to get more earnings before the bell. Will be Walgreens and Nike after the market close. Let's look at the dollar because this continues to weaken versus the euro. It is at its weakest level since September of 2021. Euro is just above 117. We're talking with Terry Wiseman of Macquarie earlier saying that the forces are there. It's not just the most recent thing moving it, which is the Journal saying that we might get something of a shadow Fed chair with Trump announcing it sooner, but it is structural forces, more spending coming out of Europe. That was at least the outcome of the NATO meeting. All right, that's it for your brief. Surveillance takes it from here.
had a number of games overseas in recent years. And in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we can do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
As long as earnings are okay, the market can ignore a lot of the bad news.
The whole market looks pretty good, actually.
The market has been remarkably resilient.
Markets seem to be calling the all clear here.
We're going to see in the short run as the market can move higher.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, pressure building on Chairman Powell.
And the fake news is saying, oh, if you fired him, it would be so bad. It would be so bad. I don't know why it would be so bad. So we have a stupid person, frankly, at the Fed. I call him Too Late Powell because he's always too late. I know within 3 or 4 people who I'm going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible.
President Trump doubling down on his criticism of Fed Chair Jay Powell. The Journal reporting Trump is toying with the idea of naming his replacement early, with as many as 5 names in the running. Hassett, Walsh, Besson, Malpass, and Waller, as the dollar is starting to sniff out a shadow Fed chair.
Yeah, you're seeing the dollar this morning at its weakest level since 2021, particularly versus the euro. The euro at the strongest level since that time. And this comes as people expect whoever it will be, the shadow Fed, to push the overall committee to a more dovish stance. And you are seeing that baked into Fed funds futures as well. I wonder how this works. Just remember, if he does nominate someone by September, that person will be the shadow Fed until May of next year as we get that sort of a term expiration of Powell.
There's a lot of runway there, and Lisa's pointing out a really important distinction. If you're just waking up to this news, this is not about an early replacement of Chairman Powell. It's about an early announcement of his replacement, and those discussions are going to start very soon.
And yesterday I was with the president in the press conference. He said he has 3 or 4 names in mind. He wouldn't ask them their names. I was shouting over, name the names. He wouldn't name the names. But we should note that already we knew they were going to start this interview process in the fall. That's what Secretary Scott Bessent said to me in April. They have a list of names. They're going to start the interview process in the fall. So already, wasn't the market expecting this all to leak? And by the end of the year, we would probably have a good idea of who the president was going to replace when Powell's up in 11 months' time.
You are going to get a ton of trial balloons. Bring up the names again. Bring up those 5 names, and we can just go through them one by one and start thinking about some of the potential successors, replacements for Chairman Powell. Think about this. You are going to have a ton of trial balloons over the next 6 months or so, and the market will get a vote on this long before the Senate does. And that means some of these names are far more credible, viable than others.
And what that means is, in terms of that trial balloon, isn't just the front end of the yield curve. It is the long end of the yield curve. And this is what I am particularly watching, if you get someone who is thought of as de facto dovish in a political manner, watch that long end yield rise. Watch the sense that people are not going to have as much confidence in the credibility of U.S. debt markets. If you see someone who seems like they are adhering more to an economic framework, then you could see the whole yield curve come down. And that, I think, is what people are watching.
The market perception is going to be really, really important here. Who is the more credible candidate? Who is the more credible candidate inside the FOMC at the Federal Reserve, which is why the likes of Neil Dutta of Renmark is really pushing Governor Waller quite hard.
Right, and he thinks that Governor Waller is someone that is credible to the market, but also is dovish in this sense right now what we're dealing with in terms of tariffs. What did he say the other day? We haven't seen the tariff impact on inflation, so why are we on hold for the past 6 months? Speaking of Neil Dutta as well, by the way, Breitbart is floating his name to take a seat on the FOMC. So next year there's going to be a lot of musical chairs.
I'm sure Neil likes that. Neil, if you're out there, good morning. If you're out there at the Federal Reserve, good morning to you too. Later on this morning, the San Francisco Fed President Mary Daly joining this program, 8:45 Eastern Time. So look out for that conversation a little bit later. Coming up this hour, Sharon Bell of Goldman Sachs with stocks stalling near record highs. Alex Norristar of the Cato Institute on President Trump's search for the next Fed chair, and the former Trump trade official Kate Kalukowicz on the countdown to the tariff deadline. We begin this hour with the dollar weaker following a Wall Street Journal report that President Trump is considering announcing Powell's replacement earlier than expected. Sharon Bell of Goldman Sachs writing, given concerns about dollar exposure and high concentration in U.S. equities, we see a structural case for more allocation to Europe. Sharon joins us now for more. Good morning, Sharon, and welcome to the program. I want to go back to some words from Chairman Powell earlier on in the week. The big question for him, who pays the tariff? What's the base case for you and the team at Goldman?
In terms of tariffs, I mean, we do think that when the 9th of July comes, it will come and go, and the tariff pause will continue. We think that we haven't reached a conclusion between the EU and the US. But ultimately, yes, we do think that that Europe will see some tariff on the goods that it's sending into the US. Although, who pays that? That's a deeper question. I think some of it will come through in US inflation, quite clearly.
And that means it could come through US consumers. And Sharon, with that in mind, does that shape your view on how you want to allocate to equities, Europe versus the US, based on who's going to absorb the shock? The consumers, companies, which companies on margins, the US versus Europe?
Yeah, so I think the thing for me with the tariffs, and in fact with recent policy in the US, is it's created more uncertainty. And this is one of the elements that's pushing down the dollar. And that the dollar falling is really focusing global investors' minds on, do I want to have all my assets in the US where I am very exposed to the dollar, or do I want to diversify across different assets where I've got different currency exposures, etc. So on the one hand, the dollar coming down and the uncertainty regarding US policy is pushing people to think about Europe, to think about other locations for investment. On the other hand, though, of course, a weaker dollar and a stronger euro, stronger sterling is a drag on European companies' earnings. A lot of them have overseas earnings, and when they translate them back into euros or sterling or Swiss francs, etc., they're going to see a hit on that.
Sharon, there are two ideas that are conflicting here. There's a question about the credibility of U.S. policy and what some of the trade wars are going to do in terms of inflation, in terms of growth in the U.S. And then on the flip side, there's the AI story, which is centered in the United States, to a lesser degree, arguably in China. And this is the reason why people are saying that it's such an attractive time to go into U.S. equities and at a discount if you're buying from overseas and you have a stronger currency. At what point do you buy into that story, given how much European assets have already rallied?
Yeah, I mean, we are increasingly getting this question from clients, both on the sort of signal that you get that European growth isn't going to be still that strong this year, and Europe doesn't have the tech exposure and the growth exposure that the US has, and the fact that the Mag 7, the AI-exposed stocks have rallied and done so well in the US more recently. Look, I'm absolutely not against AI, not against technology. I think the Mag 7 are a great group of companies in terms of they've got brilliant balance sheets, they've got ring-fenced businesses, they're investing a lot in growth, etc. So I think their growth potential is still very much there, but also quite well priced as well. And I just think there's a case for diversification, given how concentrated, when you invest in the US market, you are in that one theme, really.
The flip side of this, Sharon, is that as much as people want to get excited about the euro and the ongoing strengthening of the shared currency, there are a lot of policy questions there as well. In particular, some of the fiscal spending that will be deployed for infrastructure as well as for defense spending. There also is a question just about how much they can get their act together to generate growth and the inflationary pressures that are still present. What makes you think that the euro can keep appreciating, given that a lot of the uncertainties in the U.S. have already been priced in?
Yeah, I think, honestly, if I look at sort of fiscal spending and defence spending in Europe, I do think it's going to grow quite a lot in the next few years. All the policymakers are signalling that way. And actually, we had the German sort of budget meeting this week that, if anything, we upped our numbers on, brought them forward a little bit on the commitment to fiscal spend in Germany. So I definitely think the commitment is there to spend a little bit more money. I think on the inflation front in Europe, it's much more subdued than in the US. Growth is a bit lower in Europe. Other than the most recent spike, energy prices have been coming down a bit, and of course the strength of European currencies is pushing down on European inflation as well. So look, there's still uncertainty with respect to Europe, and Europe is notoriously late when it comes to spending fiscally, but I think that's already well known by most of the investors we speak to.
Well, most of Europe delivered yesterday, Sharon. I was at the NATO summit. 5% of GDP is going to go to defense. But is that actually going to help European equities, given the fact that if you're looking at hardcore defense, a lot of that money is going to be coming into the United States?
I don't know. I think this is something I hear a lot. But if you look pre the invasion of Ukraine, something like 2/3 to 80% of defence spend that Europe actually did was in Europe. You have very large defence industries, particularly in France, Italy, and the UK. Europe does spend a lot on defence, and not just old stuff, but also new stuff, satellites, infrastructure, technology, drones, etc. Europe will spend on all those types of areas. Also, if you look at the funding Europe's now putting into place, so the EU-level funding, EU-based finance, there is a requirement that if you're going to access that, you have to spend 2/3 of that in broader Europe rather than outside. So, yeah, absolutely some of it will leak outside. Europe needs to spend quite a lot in the next few years, and inevitably, the US has a very big defence industry. You can get certainly assets from there, but I think a lot will also be spent in Europe.
This has already been signaled early on this year. How much of this defense spending is already priced in?
Well, if you look, we have a group of companies, our defence basket. It's up something like 500% since Russia invaded Ukraine. It's up around 90 or 100% year to date. So it's done extremely well. And I do get a lot of pushback from clients saying, wow, you know, this stuff is surely already priced now. Looks, you know, on a valuation basis more expensive. If you compare it to its growth, though, if you do what we would call a PEG ratio, valuation versus growth, then it's on around 1.5, which is similar to US defence, actually. So if you think you can get this growth, it's not all that expensive. One thing we are suggesting is that people look beyond just the pure defence companies, look to more towards fiscal infrastructure more broadly, or supply chains of defence, etc. So diversify exposure now that these have done quite well.
Sharon, super thoughtful as always, and good to hear from you. Sharon Bell there of Goldman Sachs on the US versus Europe. On the US side, lots of data this morning. Look out at 8:30 Eastern time for tons of economic data from this side of things. Look out for initial jobless claims too. The estimate in our survey at the moment, 243,000 the previous week, 245. That drops at 8:30 Eastern time. With an update on stories elsewhere this morning with your Bloomberg Brief, let's cross over to Yahara Anand, who has more. Hey, Yahara.
Hi, John. We start with today's top story. The Wall Street Journal is reporting that Trump may announce Fed Chair Jay Powell's replacement as soon as September, sparking speculation that rate cuts will come sooner and go deeper than markets had priced in. The president said yesterday he has 3 to 4 people in mind for the job. Trump has called on Powell to lower rates by 2.5 points. Meanwhile, Shell is denying reports it's been actively considering making an offer for BP. The company said it has not made an approach and no discussions have taken place with BP, refuting an earlier report that 2 of Europe's biggest companies were in talks to merge. Shell's statement means it is bound by the UK takeover code, largely preventing it from submitting an offer for BP for 6 months. And shares of NVIDIA are up 1.1% in the pre-market after closing at a new record in yesterday's session. The AI darling shares have risen 60% off an April low, a rally that has added nearly $1.5 trillion to its market cap. It has now overtaken Microsoft as the world's largest stock with a market value of nearly $3.8 trillion. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, lame duck, Chair Powell.
I was wondering if you've begun interviewing different candidates for the Fed pick.
Yeah, I know within 3 or 4 people who I'm going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible.
3 or 4, or maybe 5. The latest next with Alex Norristow of the Cato Institute, live from New York City. Good morning.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Snapping a 2-day winning streak on the S&P 500 in yesterday's session. Jim Reed over at Deutsche Bank, the smallest move since 2017 in yesterday's session. Equity futures this morning positive by 1/3% on the Nasdaq, up by 0.45% as the rally starts to resume. Under surveillance this morning, lame duck, Chairman Powell.
I was wondering if you've begun interviewing different candidates for the Fed pick.
Yeah, I know within 3 or 4 people who I'm going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible. He's an average mentally person. I'd say low in terms of what he does, low IQ for what he does. I think he's a very stupid person, actually.
So here's the latest this morning. The Wall Street Journal reporting President Donald Trump is considering naming Fed Chair Jay Powell's replacement earlier than expected. The announcement could come as soon as September. Bloomberg's Tyler Kendall joins us now from the nation's capital with more. Good morning, Tyler.
Yeah, hey, John, good morning. Well, as you're mentioning, the Wall Street Journal has this report, and I'll give you some context here. The first time that Jerome Powell was nominated for the role, he had a 3-month runway to go through the Senate confirmation process. That's considered to be typical, but let's say that President Trump did appoint or nominate somebody by September. That would be an 8-month gap to May of 2026. Now, the Treasury Secretary Scott Bessent had told Amory earlier this year that the formal interview process wasn't expected to kick off until the fall, but it is clear that President Trump here would like to get it going sooner. And we know some of the names that are up for consideration, including the Treasury Secretary himself, somebody who by and large has President Trump's trust and is also considered to be a pretty soothing presence for the markets. In fact, our own reporting indicated he was the one who urged President Trump back in April to make clear that he has no intentions of letting Fed Chair Powell leave the post before May of 2026. And that really is the needle that any potential potential pick is going to have to thread here, navigating President Trump's ire while also reassuring that there's going to be an independent central bank.
Tyler Kendall with the latest down in Washington. More from Tyler later this morning, and Mike McKee's going to be with us very shortly as well to weigh in on this situation. And later, 8:45 Eastern Time, Mary Daly, the San Francisco Fed president, joining this program. Lisa, I imagine she's got some thoughts on this situation.
Yeah, and the increasing politicization of the Federal Reserve and how that affects their decision-making. Cheat sheet, probably not at all, because they're looking at the economic data and trying to come up with the best situation possible. I do think, though, your point about the market having a vote is an important one. And right now, we're not seeing the long end of the yield curve rise. We're not seeing yields go up. And that is a good sign, even with dollar weakening. If it were going in the opposite direction, then the alarm bells would start going off.
Out of those five, there are some very credible names to replace Chairman Powell. Out of those five, there are also some less credible names to replace Chairman Powell. And when you start to narrow them down, if we start to throw out some trial balloons of individual names, that's when the market's really going to get a vote on this.
Yeah, if you start to have somebody who might just cut for the sake of cutting, not because the economic data justifies it.
Precisely. To build on this conversation, Alex Norrister of the Cato Institute joins us now for more. Alex, welcome to the program. Do you think we're on course for a shadow Fed chair later this year?
I think that that's very likely to happen. I want to, though, point out this is definitely an improvement over President Trump's earlier statements when he said he wanted to remove Powell early. President Trump was probably chastened a bit by the decision in Trump v. Wilcox, which was a decision by the Supreme Court recently that allowed him to fire the heads of some independent agencies. Now, in that case, it was brought up that, the Federal Reserve is kind of an independent agency like this. Does this mean if Trump can fire other heads of independent agencies, he can fire the chair of the Federal Reserve? And the court said, no, the Fed is special. The Fed is walled off. The Fed is a special institution in American history, like other central banks in American history. So it sort of removed that threat. And so this is a way of Trump, I think, dealing with the court not giving him all the power he wanted, which is vital. I think we all know how important an independent central bank is for credibility and for keeping politics at least at a distance from monetary policy.
To that point, the Treasury Secretary said to me in April that monetary policy was a jewel box that needs to be preserved. But at the same time, Alex, does the administration potentially risk shooting themselves in the foot? Because this could be damaging to the market if they think that this basically impacts their independence.
It could absolutely be dangerous to the market. It could impact the credibility of the Federal Reserve. Listen, Trump is playing a very fine line. He likes to do this frequently on lots of policy issues. There's an enormous amount of uncertainty. You see that in the market's reaction to multiple of his policies. You're going to see increased uncertainty. This is certainly not ideal. I think the ideal situation, given the constraints of current public policy and laws in the U.S., is to let the Fed do its thing and be the independent central bank it has been throughout much of its history in the United States, not try to meddle in these things. But that's not really Trump's way. I think the market understands that's not Trump's way. Fortunately, the Supreme Court and the courts have held Trump back and restrained him, so we have more certainty than we would if Trump had his druthers. However, this is just going to be a very chaotic time, I think, in American governance, and that's going to affect these institutions negatively. And I think the markets have basically priced that in. The economy has priced that in, but we just don't know how much worse it could get or if the courts could rein it in and make it better. It's really an uncertain time in a lot of ways.
Well, based on his cabinet appointments, we do know that he loves an episode of The Apprentice. How will the Senate Finance Committee and the House Financial Services Committee, though, welcome this?
So that is that's a really important point. They will probably, predictably, the Republicans are going to be fine with it. Most of them are going to be fine with it, and the Democrats, of course, are going to be angry. What they're really focused on right now is the debate over the one big beautiful bill. Over taxes and fiscal policy, and it's unclear how that's going to sort out. There'll be a vote very shortly in the Senate about this bill going forward. And that, I think, is really dominating the discussion. And then after that, perhaps you could see things turn to the Fed. But there are a lot of issues that are coming up right now in Congress that could attract their attention at the moment.
I'm so glad you went there, Alex. It seems like we're focusing on the next Fed chair when we've got two looming deadlines ahead of us, the July 4th big, beautiful bill vote that they kind of need in order to avoid breaching the debt limit. And then there's this question of how the negotiations are going with tariffs. How confident are you that they are going to get that bill passed in time and then keep on track that July 9th deadline for some of the tariff negotiations?
So I think they are going to pass a bill on time to avoid running up against the debt limit. Nobody in Congress really wants to go up to that limit. Even if it's not sort of the final version, they will push something short term to at least not cause a disaster in that regard. So they'll do something, and they'll probably be able to finish it by the fall. In the worst case scenario. But in terms of the other deals, I guess, in terms of tariffs, is the other deal that is looming on the horizon. If you recall, Liberation Day, April 2nd, we had until 90 days for deals. The 90 days run out on July 1st. Kevin Hassett said there's no deals that are going to be introduced until after July 4th, so he's already pushed back that deadline. So I don't think, this is just the unserious policymaking that I think we all suspected it was from the beginning. Instead of 90 deals in 90 days, he's basically said we're going to have to get like 88 deals in 88 hours if you're going to take that timing seriously. I don't think most watchers take it seriously. I don't think the markets take it seriously. I don't think firms that rely overwhelmingly on international trade take it seriously. And I certainly don't think consumers should take it seriously. And you see this reflected in the consumer surveys about confidence. I mean, it's not as bad as it was during COVID.
Hold on a second,
but it sure looks like we're there.
In fairness, a lot of people didn't take the president seriously during the campaign when he started talking about some of these levels. And we are going to see tariffs. We have seen tariffs come through. Isn't there a good degree of complacency over what could transpire on July 9th, which is the reason, going back to the beginning of our conversation, that the Fed has said they're on hold because they don't understand exactly what the input's going to be because it hasn't been written yet?
Listen, I think you came back to the defining issue of this administration, which is the uncertainty that has been introduced at multiple levels of public policy by the president, but also by Congress and by a lot of our institutions, which are not functioning as well as they ought to be. I mean, thank goodness for the courts keeping everybody more sane than they should be. But this is a very odd time. It's very easy to be confident about our predictions. Clearly, a lot of people have not been correct in those, myself included. I've been wrong a few times on some of these predictions as well. But I do think that the one thing you have to deal with for the next 3.5 years is President Trump in the White House with an extraordinary amount of power over economic policy, making decisions as he goes, and a lot of them are going to surprise us.
Alex, appreciate your time, sir. Alex Norrestad, the Cato Institute, on some of the policy issues down in Washington, D.C. How's it shown up in the markets? 6 days of dollar weakness against the stronger euro. Euro-dollar through 117 this morning, 117.20 at the moment. Levels we haven't seen going back to September 21.
And it comes with a lot of anecdotes of big institutional investors who aren't necessarily shifting wholesale or selling their U.S. exposure, but they're adding exposure to the euro region. I just wonder whether we're underestimating some of the punitive aspects of these tariff deals and what that does mean to the United States and how much that isn't fully being priced in yet.
I'm going to take the other side of what Alex was saying. I was not surprised in what the president did. We know from the past, especially when he was dealing with China, he starts from a maximalist approach and then works his way down. And that's what Liberation Day was. The question now is, what does he settle on? It's very obvious we're going to get a 10% ring around the United States in terms of tariffs, but some other countries, especially the European Union, does it actually come up? Is it going to be higher?
July 9th feels like a moving target going through the end of June into early next month. Up next on the program, former Trump trade official Kate Kalukowicz ahead of President Trump's July 9th tariff deadline. Plus, Danny Berger with your morning movers as NVIDIA posts a new record high. That stock is up at a pre-market by 1.2%. Live from New York, you're watching Bloomberg TV.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Inching back towards all-time highs on the S&P 500 this morning, up by 1/3 of 1% on the Nasdaq 100, adding some more weight to the rally, up by another 0.5. With 3 hours until the opening bell, let's get you some morning movers and cross over to Danny Berger. Hey, Danny.
Hey, John. 3.77 trillion, the new market cap for NVIDIA. It overtakes Microsoft to become the biggest company in the world. And we add to that this morning, reaching a new record high yesterday. Really the rally starting with earnings season, seeing all of these hyperscalers continuing to invest in AI. So shares are up 1%. We also had the shareholders meeting where Jensen Huang, won't surprise you, was very bullish on NVIDIA's prospects. Other chip stocks rallying today. Micron, we got earnings after the bell. Really strong set of forecasts. The forecast to the upside on a surprise. Those shares are up 2%. It also won't surprise you why. They say that AI demand is really strong. Given what they forecast, it will be a record year for Micron. Now to the downside this morning, we do have Trade Desk. This is a company that provides an ad tech platform. Basically, you give ads to them, they put them everywhere. Getting a downgrade from Wells Fargo this morning, saying that they are feeling more competition and will feel more competition from Amazon, which offers a very similar product. Its channel checks suggest that customers are willing to give more money to Amazon instead of Trade Desk. So those shares down just under 2.7%, John.
Danny, thank you. Thanks for the update. Danny with the latest movers this morning. On our radar this morning, our top story, the Journal reporting President Trump is considering naming Fed Chair Jay Powell's successor early, with up to 5 names in the running, including Kevin Walsh and Kevin Hassett. Mike McKee joins us now for more. Good morning, Mike. Your take on things this morning, please.
Well, this isn't a news story. This has been bandied about for quite some time. Scott Bessent raised the idea on the campaign trail, and at one point then he backed away from it. It seems to have come back a little bit. I have talked to a couple of those people on that board there, and they have said the president has talked about doing it early, but they caution that this is Donald Trump, so nobody has any idea what he's going to do. But if Trump is really mad at Jay Powell, he may try to do this just to get under Powell's skin.
Mike McKee, as you know, typically people who go through this process, the interview process to join the Federal Reserve Board, typically they go quiet. They don't give broadcast interviews. They don't write op-eds. And I think that could be the difference this time around. Is that what you're expecting?
Not necessarily, and the reason being is a couple of those people, their job is to talk. Kevin Hassett and Scott Bessent represent the administration on the economy, and that's not anything new. When Ben Bernanke was chosen as chairman, he was the head of the CEA, so he was always talking to the press as well. But once the nominee is chosen, then they'll go quiet because they don't want to upset anybody up on Capitol Hill. I don't think anyone would hold against Hassett or Bessent that they're talking about the economy right now because the president expects them to do that.
Talking about the economy is one thing. Talking about interest rates, quite another. Mike McKee with the latest. Mike, thank you. Are they going to go around talking about interest rates? I imagine they're going to go around talking about interest rates.
If they talk about interest rates, then keep watching the reaction of both the dollar and the yield curve. What you are worried about, or what the market is worried about, is financial repression. artificially capping yields either by quantitative easing or artificially lowering rates in a way that is inflationary or potentially reduces the value of the U.S. dollar in a material way. And that, I think, is what you mean when you talk about credibility and people's understanding of this as an economic tool and not necessarily one that is highly political.
Speaking of credibility, Kevin Warsh was quoted as speaking in a closed-door event. Now, all of these people in closed-door events are going to be, everyone in the audience will be hyper-focused on everything he said. He said, "My fatal flaw is I say what I believe. If the president wants someone who is weak, I don't think I'm going to get the job."
Is that what he said?
That's what he said. But he did go on to say that he wouldn't be shocked if the president made this nomination sooner to, quote, try to make a lame duck lamer or something like that.
Kevin Warsh has hawkish feathers. Let's be very clear about that. It wouldn't really make sense ideologically to appoint Kevin Warsh to the Federal Reserve to be chair, given what the president wants to see.
A lot of people have said that, which is the reason why people are watching some of the rhetoric. For example, Michelle Bowman coming out the other day saying that she could cut rates as soon as July, even though last year she was incredibly hawkish, again, raising questions.
Another change in the Federal Reserve as well, unveiling plans to change a key bank capital rule called the Enhanced Supplementary Leverage Ratio, which applies to the largest U.S. banks. The Fed Vice Chair for Supervision, Michelle Bowman, saying the proposal aims to reduce Treasury market dysfunction.
The idea here is that the U.S. Treasury market, the amount of debt outstanding, has almost doubled in the past decade. And banks have argued that they have been unable to increase their trading activities and their market making in a commensurate way, given the fact that they have these restrictions. Key question, how much will they continue to buy or expedite buying of treasuries if they do have reduced rules in terms of the capital holding requirements? Unclear. Why would they want to take duration risk right now?
This is just a sign of the direction the Federal Reserve and regulators are heading in, though, right? Isn't it the optics here that's important for a lot of people?
That is the crucial point, and you are making exactly the dead-on important point that this is going to be a wave of deregulation. We haven't fully seen it, and that is the reason why financial stocks have been flying, because people expect more to come.
That's why a lot of people have been constructive, deregulation and tax cuts. The GOP divided on the SALT cap. Can they solve this, address this issue by July 4th, Independence Day? The Senate Majority Leader John Thune still optimistic they can get the bill on the president's desk by early July.
Well, the administration is spending a lot of time on Capitol Hill. Just yesterday, the Treasury Secretary was there. He met with Senator Mark Wayne Mullen, and then together they met with these holdouts in the House when it comes to SALT. Now, Nick LaLota of New York was saying how it was a cordial conversation. That doesn't sound too optimistic to me, but they clearly want to get this over the finish line. One GOP aide has said that potentially they'd keep the cap at $40K, but they would change some of the thresholds of who can actually go back and be able to use that cap. But they're going to have to figure this out. There is no Republican senator from a blue state. The problem is, to get it past the House, they have to include the SALT cap in this bill.
A lot of important deadlines coming up. July 4th, the self-imposed deadline to pass the tax bill. Then July 9th for trade. The president is threatening to double tariffs on Spain ahead of his July 9th deadline for failing to adopt NATO's new defense spending targets. The former Trump White House trade official, Kate Kalukowicz, joins us now for more. Kate, welcome back to the program. Can you discriminate against and target just Spain, or does the rest of Europe need to feel the pain too?
Well, it's certainly a challenge given the makeup of the European Union and the way that they regulate trade at this EU level. But I have no doubt the Trump administration can find a creative solution if they seek to target Spain. We've done it in the past through retaliatory tariffs directed at specific markets. So I suspect his team is thinking up ways right now to do so.
What could that look like? What would be on the menu of options for the president?
Well, you know, in the past, we have seen targeted trade actions at specific member states. One specific example, of course, was the retaliation against Airbus, the airplane consortium that the United States was upset was unfairly subsidized. That consortium is led by France, Spain, the UK, and Germany. And so in its retaliation, the U.S. Trade Representative was able to look at exports that are specific to certain member states. So, you know, with Spain, you might look at certain citrus exports. You could look at wine. There are ways looking in the tariff code to target specific countries.
Kate, what is the status right now from your understanding of what is going on with the European Union? Because approaching this deadline, they said even if the administration keeps the 10% baseline tariff, they are going to retaliate. I'm glad you brought up Airbus, because the European Union in Brussels is looking at retaliating against Boeing when it comes to the United States.
That's right. They have assembled a pretty strong arsenal to come in if they don't get what they want, and if Trump does decide to go ahead and put the tariffs back in place. I think it depends on who you talk to around how the negotiations themselves are going, and reflects this problem between the United States and the European Union when it comes to these types of trade negotiations. What we have seen in the past is that if you get bogged down in the details, you are really going to struggle to find an outcome. Now, what we've seen work, of course, I mean, I see the images here of President von der Leyen and President Trump, is when the two leaders get together in the room, they could emerge with a very high-level agreement that satisfies the president and enables the working level negotiators to keep going. That is the only outcome I see actually working here.
So in other words, kick the can down the road. It's either kick the can down the road on July 9th, or else we're going to be mired in a whole lot of confusion and potentially trade war types of dynamics that could disrupt markets.
That's exactly right. And it's what happened during the first Trump administration when he threatened tariffs on the European Union. The then Commission President, Juncker, came in, offered to buy soybeans, offered to buy LNG, and kick the can down the road. And so we do find ourselves in that same situation, same concerns. But, you know, if the member state reps, German chancellor, for example, coming out last night saying we have got to take care of this, can convince the commission president that she needs to offer some of these high value concessions, we may be able to kick this can down the road.
Kate, I want to understand the framework of what's a credible argument with the Trump administration when it comes to reducing some of the tariff load and what isn't. Japan's chief trade negotiator came out in the past 24 hours saying that the country can't accept the 25% tariff on its cars, considering that it makes more cars in America than it exports to the country. Is that a credible argument that will actually be effective in reducing some of the levies?
I don't think it is, because if you look at the justification for the car tariffs, the justification is to promote manufacturing in the United States. So the president has repeatedly stated the only way to avoid those tariffs is to move manufacturing to the United States. He has argued, I think, quite consistently that this is working, pointing to all of these investment decisions by foreign companies, not only in the auto sector. So I don't think that justification makes a lot of sense. The Japanese, I think, have other tools here to offer. We saw it in the case of the agreement with the United Kingdom. Commitments, again, to buy U.S. agriculture. Largely, I think we'll see a push to increase defense spending, as we saw the president succeed in the NATO talks with Europe. So foreign leaders really need to be creative, I think, in terms of what they're prepared to offer. It's not always a direct line between sectoral arrangements.
Kate, when it comes to the timeline, are we going to see any deals before July 9th?
Well, I sure hope so. I mean, I think that the White House and the president's surrogates are certainly laying out the likelihood that we would see a delay, and a delay based on progress. You know, the connection yesterday or the day before from Kevin Hassett to the big, beautiful bill also shows me that they're using this as leverage to get some of the Republican holdouts in the Senate who are pushing for deals to move on the tax bill. So all these moving pieces signal to me that the president will provide some delays. The question for me more is around the trading partners that were assigned reciprocal tariffs but have not really had their turn at the negotiating table with the Trump administration. So I think in some cases we have to take the president at his word that some of these tariffs are likely to come back.
Hey, Kate, great to get your thoughts on the program this morning. Thanks for joining us. Kate Kalukowicz there, the former Trump trade official, on just how interconnected July 4th and July 9th seem to be.
Yeah, I love this sort of fungible idea of we can offer you a benefit on the tariff side for your state, and then you sign off on the bill, and then you sign off on this later, and then you can sign off on the Fed share. It's this ongoing negotiation. Then tell us to get a little bit cooler because it's been too hot.
The president is constantly trying to look for leverage, whether it's with foreign partners within his own party in Congress. But if there are no deals for a host of countries that they haven't actually gone to the table with, as Kate Kalukowicz was talking with, then the president says they're just going to get a letter. There's going to be no engagement. It's just going to be, here's the letter, here's your new tariff rate. I agree, Liberation Day was too high, but this is what you're going to pay. And I don't think anyone is getting below 10%.
You're still complaining about the heat?
Well,
is that what that was?
Yes, I am. I'm sorry. It was still disgusting
yesterday. It starts to break today.
It starts to break. I mean, honestly, it was pathetic.
It was so nice in the Netherlands.
It was pathetic.
Yes, well, and I worry about the penguins. What kind of trade deal are they going to get?
Oh, right, okay. All right. You're right to worry.
Right?
Maybe their conversation hasn't started.
They're going to get a letter, and they're going to say,
Sure, they're terrified. Do you want to do that again? Give that a miss. Okay, let's move on. Equity futures right now in the S&P, positive by about 1/3 of 1%, with an update on stories elsewhere and some breaking news. With your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Hi, John. The Treasury says it's nearing a deal that could make the so-called revenge tax irrelevant, potentially offering relief to investors worried about punitive tax measures. The revenge tax provision in Trump's tax bill would impose a levy on companies and investors in countries the U.S. claims have imposed unfair taxes on American tech. Meanwhile, President Trump says the U.S. and Iran will meet next week, but he's casting doubt on the need for a diplomatic agreement on Tehran's nuclear program. That's because he says the U.S. strikes on Iranian nuclear facilities obliterated them, setting back its atomic program. His team is expressing hope for a comprehensive peace agreement with Iran. And former Barclays boss Jess Staley lost the legal battle to overturn his ban from the city watchdog over his relationship with Jeffrey Epstein, all but ending his attempt to rehabilitate himself in the British financial services industry. That's your Bloomberg Brief. John?
Yahara, thank you. More updates on that story in the next couple of hours. Up next on the program, the consumer under pressure.
Someone has to pay for the tariffs, right? So we haven't seen it in the price data yet. It's too soon to know exactly where it shows up. But if we're not seeing those big price increases being passed on to consumers, I think that's telling us the consumer is weakening.
In just a moment, on consumer confidence, Dana Peterson of the Conference Board, live from New York. This is Bloomberg.
Welcome back to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we don't want to lose you, Emily, in all of this?
Stargate. Put that name down in your books.
What we're undergoing right now is sort of the largest infrastructure bill in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Equities at the moment firmer by 0.33%. On the Nasdaq 100 up by 0.5. Just a sneak peek of the bond market for you. A lot of focus at the front end of the curve. We've talked tons on this program about how anchored the front end is around this Federal Reserve that's not going to do anything anytime soon. The two-year yield's at 3.75 now. It's just breaking away, pulling away from 4%. And I would say we have broken that anchor. We're down 3 basis points. This is the 5th session we've seen the two-year yield decline. And over that period, we're down almost 20 basis points now, which I think is notable. Given maybe the introduction of some rate cuts offered by Governor Bowman and Waller over the past few weeks. But also, you've got to think about also here, Lisa, the prospect of a shadow Fed chair in the next several months too.
Regardless of whether you believe that person A will be nominated, B get through, and then C have an influence over the committee, we are seeing the discussion influenced, if not by that, then definitely by some of the comments that we've heard from Chris Waller and Mickey Bowman. There is almost a 90% chance of a September rate cut currently priced into the market. That is up from about 60% last Wednesday after the Fed meeting.
The economic data important as well later on this morning, 8:30 Eastern time, jobless claims in focus. Under surveillance this morning, the consumer under pressure.
Someone has to pay for the tariffs, right? So we haven't seen it in the price data yet, so it doesn't look like consumers are paying for it yet. Maybe exporters are paying for it, but maybe it's getting absorbed in margins too, and maybe businesses would be looking to cut costs elsewhere to offset that. So I think it's too soon to know exactly where it shows up. But if we're not seeing those big price increases being passed on to consumers, I think that's telling us the consumer is weakening.
Here's the latest this morning. Concerns about the U.S. consumer ramping up. Economists at the Conference Board writing consumer confidence weakened in June, with consumers' assessments of the present situation and their expectations for the future both contributing to the deterioration. Joining us now is Dana Peterson of the Conference Board. Dana, welcome to the program. There is some criticism of some of these surveys, not yours, but elsewhere, whether they are economic surveys or political polls. How would you describe what we're learning from the consumer at the moment?
What we're learning is that consumers are still very worried about the future, and they're starting to become so worried about the present as well. Indeed, our own confidence measure dipped again in the June reading and is well below where we were in January before the tariff announcements.
A lot of people are looking at your data and your consumer confidence read and the data beneath it, the individual components, the so-called labor differential. And they're pointing to that and they're saying consumers are telling us right now that they don't believe this job market is that hot. And from an economics perspective, that's a decent way of saying, I'm not worried about second-round inflationary effects because you're not going to see this passed on in higher wages. Dana, is that your conclusion?
Actually, no. The labor market is actually fine. What consumers are saying is that it's difficult to find a job right now. It doesn't mean that people are largely unemployed. If we look at the unemployment rate, it's still very low. It's more the case that businesses are on hold. They're not hiring people because there's a lot of uncertainty. And other businesses have everyone that they need because the labor market is more or less in balance. You also have to remember there are a lot of young people graduating from college who are finding it difficult to find a job, again, because companies are in stasis. So I don't think it's necessarily saying the labor market is bad right now. It is just difficult for people who find themselves unemployed to find another position.
Dana, to pair these ideas, have you ever before seen such a divergence between people feeling bad and still going out and spending money, not necessarily acting as though they feel bad?
Absolutely. We saw that over the last 2.5 years where most everyone was saying that there was going to be a recession because inflation was rising rapidly and the Fed was tightening interest rates. But consumers, even as they complained in our survey, they still went out and spent because they were working. They were also seeing their wages rise at a pretty rapid clip relative to what we saw between the great financial crisis and the pandemic. And, they also had pretty decent savings. And so consumers, even though they were saying the world is awful because inflation and prices are high, they still spent because they had the capacity.
I don't want to get too psychological here or philosophical, but that really raises a question of how important it is to understand sentiment, how important it is to really use some of these gauges as a forward-looking indicator of exactly what people are going to do, of the state of the consumer. How much does this really call that into question? If people are annoyed by things, but they aren't changing their behavior, it doesn't have an economic kind of ramification.
Actually, in our latest survey, we did ask people if they were changing their behavior. And certainly people who had more money were starting to put away savings, just in case. And people who had less money were actually dipping into their savings to purchase things that they needed, like goods and services. So people are changing their behaviors on the margin, but there's still a lot of uncertainty. We don't know what the tariffs are going to look like after July 9th. And certainly we haven't seen inflation rise because companies did stock up and may be selling out of those inventories at a lower price. But certainly when tariffs return and we start seeing inflation rise and consumers probably will pull back, and you may also see the unemployment rate tick up, then that's not a good scenario. And that's what I think consumers are very concerned about right now.
When you see especially the write-in responses, do you see the easing of concern that matches potentially with headlines of the administration talking about deals being done?
Actually, the write-in showed that the top two things that consumers believe would impact the economy were tariffs and prices/inflation. So consumers are watching the news. They understand that tariffs mean higher prices. And so they're putting those two things together and they're saying, look, we're worried about the second half of this year.
Dana Peterson at the Conference Board. Dana, appreciate the update. Thank you. We've all seen the news. It's been incredibly volatile, and where we are today is not where we were on April 2nd, and where we'll be on July 9th is still unclear.
So does this really mean that people feel bad and are acting on it in a material way, or does this mean that we're all in wait and see? I was kind of laughing when you pointed to Jim Reed's comment about the tightest range going back to 2017 for the S&P 500. It was something like negative 0.00000 something or other. And I'm thinking, we're all in wait and see. We're all kind of on hold, because how do you make big decisions other than just say, I like chips?
At some time, you've got to make a call. At some point, right? We'll catch up with Mary Daly later this morning, the San Francisco Fed president, 8:45 Eastern time. I think a question for her is, when will you know? How much time do you actually need? Because this could be a feature, as you've said a million times, a feature of this administration, not a bug, for the next several years.
When is data not backward-looking? When is it the actual reality? When is it the new normal? And when can you actually say that? Because a lot of people are saying, if you look back, the disinflation would justify a rate cut, especially in light of the increase in the unemployment rate and, frankly, the jobless claims that we're going to get in about an hour and a half.
This sort of trade ideas that potentially you could have more tariffs, left tariffs on, off, like a light switch, Trump is using every single day. We saw him use it at NATO because Spain refused to come to the table to spend 5% of their GDP towards defense, and Trump said, I'll make it up. With a trade negotiation, I'll get them back somewhere. So it's really hard to plan when potentially you're going to have a president that is going to use tariffs as a threat, and then some days he's going to deliver.
What is up with Spain? We figured that out.
I mean, honestly, they like China. They want to go there. They also are saying, we're good. We don't need to spend. And guess what? We're fine. I feel like they're trying to make themselves different, and I'm wondering how this is going to go.
Europe wants to complain about the US not being a reliable partner when it comes to Russia and Ukraine, and then Spain goes around behaving the way Spain does when it comes to China.
Spain said they're not compatible with some of the larger goals. But again, this goes to the question of, you're going into the euro instead of the dollar. Okay, with or Spain?
117 right now on euro dollar. Up next, what would you do on your birthday? You'd come on Bloomberg TV.
Amen.
Jim Zelter of Apollo, happy birthday. Joins us next. Bloomberg's Tyler Kendall, Mike Schumacher of Wells Fargo, and Russell Brownback of BlackRock. Join us in the next hour, a stacked hour of Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Was it easy to get the pandas to come back to Washington, D.C.? Did the Chinese say, we have some extra pandas, we don't know what to do with them, we're going to give them to you?
Well, it was a little more difficult than that. It probably took us, it was about over the course of a year where we had conversations with our colleagues in China, and we were able to get pandas here very quickly. I think it's a testament to the relationship we've built over decades, to the conservation success that we've had, here with our pandas and our panda program. And so it was a lot of conversations, but I think we always knew in the end that we did want pandas at the National Zoo.
How many many pandas are there in the entire world?
So this is incredible because this is all due to this panda program, and this is so important. So when we started with giant pandas 50 years ago, there were fewer than 1,000 pandas in the world, right? We're talking in the wild and zoos, fewer than 1,000. And decades later, there are close to 2,000 pandas in the wild now. Actually, I think a little over 1,800. There are over 700 pandas in breeding centers. So as part of this program, we have tripled the number of pandas on the planet.
But still a small number of pandas.
Because of this program, there are more pandas on the planet, more quality panda habitat in the wild, and pandas have gone from being endangered to being vulnerable.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
We're also seeing a lot of macroeconomic volatility.
The economy is growing in an interesting way, in a different way that the official numbers are not picking up.
The U.S. is kind of handcuffed in what it can do because it can't really afford inflation.
The Fed has been excessively data dependent.
At some point, they're going to get pushed into cutting.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, live from New York City this morning. Good morning to you all. Your scores look like this on equity futures. On the S&P 500, positive this morning. Positive largely across the board, up 1/3% on the S&P. On the Nasdaq 100, adding some weight to the recent rally. At or close to all-time highs in this equity market stateside, up another 0.4%. At the front end of the yield curve, things are starting to get really interesting. The two-year yield backing away from 4%. 375 this morning, down another 2 or 3 basis points and lower over the last 5 sessions, as maybe we start to open the door to rate cuts over the next several months, and we start to consider this from the Wall Street Journal. The President of the United States maybe naming Fed Chair Jay Powell's successor a little bit earlier than expected.
So there are a couple of ideas here embedded in what you're talking about. With President Trump, there is this theory that he could nominate someone as early as September or October to be the next Fed chair, even though Chair Powell's term does not end until next May. This would present a sort of influential voice that could counter Powell, that could potentially cause sooner rate cuts. And then there's the economic data that has been softening. So these two interplays raises a question of how much of the market action is political and how much is actually fundamental about the economic data.
From the market perspective, this is an improvement on firing the Fed chairman.
Correct.
So there's that. From the market perspective, by the time we get to September, the Federal Reserve might already be doing what this president would like to see.
Exactly, and he has interest rates on his mind and he wants to see them lowered. He continuously says that, whether it's 1 o'clock in the morning or to reporters yesterday in front of us at NATO. He constantly is thinking about interest rates and he wants them lowered. So now he's thinking about who is going to fill this role 11 months out. The Treasury Secretary told me the interviews will start in the fall. But once the interviews start, you know that a bunch of names are going to be floated. And this is classic Trump. He loves The Apprentice. He did this with the Treasury Secretary race. He did this with a number of cabinet races. He wants to drum up support, and you're going to see individuals maybe write some more opinion pieces, as we saw from David Malpass, maybe go on some more programs, because now it is actually a race to get the attention of one man.
Bring up the 5 names. Go through them. Already, everyone around the world making a decision. Going through these names one by one. Who do I believe is economically, intellectually independent from the President of the United States. Who am I going to sell bonds on? Who am I going to buy bonds on? Who do I sell the dollar on? Who do I buy the dollar on? I've got my opinion. You don't want to hear it. I think a lot of people have already established their views on this situation as well. And that's why we keep saying the market will have a vote on all of this way before, long before the Senate has a confirmation here.
Who says that we don't want to hear your opinion, John? Lay it out. I know you've got a PowerPoint. Come on, you know, this person. Look,
I'm avoiding it this morning.
I think that that's wise. I think for myself, I'm going to avoid it as well. There is a question, though, of how much the market is going to view this as financial repression versus just taking a slightly different interpretation of economic data in still a prudent and economic way.
We'll spend some time on this through the next hour or so. Coming up on this program, through the next 60 minutes, we'll catch up with Jim Zelter of Apollo on deal-making in an era of policy shocks, Mike Schumacher of Wells Fargo on increased defense spending weighing on bonds, and Russell Brambach of BlackRock as traders boost bets on Fed rate cuts. We begin this hour with the dollar slightly weaker as the Journal reports President Trump is toying with the idea of announcing replacement for Fed Chair Jay Powell earlier than expected. Joining us now for a long discussion, Jim Zelter, the president of Apollo Global Management. Jim, good morning.
Good morning, Jonathan.
And happy birthday, sir. It's good to see you.
Thank you very much. I appreciate it.
We
Great
won't
day so
spend
far.
too much time on the Federal Reserve, but I do want your reaction to this Journal piece overnight.
Well, I think that the president's already won. It's a great distraction of headlines. I personally don't think he's going to name anybody too early because right now he's in the catbird seat of blaming without accountability, which is classic Trump playbook. So I think the fact that we're talking about it is interesting. It's a great diversion from the reality. I think he does. There's no doubt he wants rates lower. That's what's part of his plan for many, many years, and that's how he doesn't like to pay debt, and he likes to pay low coupons on it. But the fact that, you know, I just don't think that if you're Trump right now and you take his playbook, he'll make this a conversation, but I don't suspect he's going to do anything premature because he's able to put blame on the current resident of the Fed, and he likes to be in that position.
In your words, blaming with accountability, without accountability,
Yeah.
is there something you think he should be accountable for?
Well, certainly I think if you think about what's going on in the last 3 or 4 months, the issues of tariffs, it feels like that's a little bit on the sidelines right now. I know we haven't resolved it, but the marketplace has absorbed the idea of a 10% plus or minus tariff, maybe a little bit higher. But to Trump's benefit and the administration's benefit, the market has absorbed that and moved on. The issues about the Middle East and all the challenges of foreign policy, there was a lot of action last 10 days ago and a week and a half ago, and now that has been sort of absorbed in the marketplace. The big elephant in the room is still our deficit issue. You guys have talked about it quite a bit. It's obviously the topic of appropriate conversation. And so I think that is an important topic that still remains. But, you know, we talked earlier in this year about the decline of U.S. exceptionalism. I think Mark Twain was right, that my death is a bit premature. And certainly the market has moved on. So I think the tariffs are a little bit off on the side. The foreign policy issues are a little bit off the side right now. The deficit issue is a real issue. We could talk a little bit about what's going on with the dollar. I personally think what's going on with the dollar, I think there was a lot of investors around the globe that invested in U.S. assets, and they made money both ways, on the currency and on the underlying assets for almost 10 years. And they turned around and they found themselves really unhedged. And I think you're going to see some pretty good numbers out of the big banks this quarter because investors around the globe have been rushing to hedge their dollar exposure. But I think it's a 10-year catch-up that people just didn't hedge their portfolios in massive scale. So I don't look at this dollar decline as I look at it as more of a technical factor than a long run impact on the health of the U.S. economy.
There's a lot to unpack there, including the breakout of the hedging profits at some of the big banks, which we'll all be now looking for. To build on what John is asking about, is the Fed on the brink, I don't want to say of a policy error, but of being too late, kind of to build on what President Trump is accusing him, because you are seeing the weakening in the dollar accompanied by the biggest negativity, the biggest increase in downside economic surprises that we've seen in a year.
If you look at the Bloomberg page on rates of the G7 economies, other than the UK, we're the outlier in terms of where our 10-year yields are and our yield curve is. You know, I sit in my seat and I see a variety of inputs that some tell me the economy is slowing down a little bit with consumers. Some tell me inflation is still a little bit more represented in the economy. We see inflation around 3%, 3.5%. And I don't think it's obvious that the Fed should be cutting right now. I think it is a very legitimate question to be asking, what's the trajectory of the Fed activity? And so I don't think it's a slam dunk decision. I know the market, the futures would tell you 3 cuts in the rest of the year, 3.5 cuts. Torsten and I are a bit skeptical on that. We see what's going on, and I think there's maybe 1 cut. Your basic question, is the Fed conversation a really important one right now? It is. I have a view that rates are going to be a little bit stickier and higher in the U.S. than people think. We've had that view for quite some time. But so it is a good question for the administration to have right now, but I'm not sure that's the primary question for the market.
One of the reasons why people keep asking this question is, would the Fed be considering cutting for the right reasons or the wrong reasons? The right reasons being disinflation, which you reject, but the wrong reasons being because we are seeing a weakening in the labor market, as we see as the increase in jobless claims. What's your sense of that based on what you've seen with portfolio companies, what you've seen with your investments? Is that valid?
Yes, I think long-term, you can't argue with the long-term deflationary impact of technology and AI. That is out there. Now, whether that's 6, 12, 18, 24 months, there's a massive deflationary impact from that activity. I just don't think it's on the center of the plate right now in the markets. It's out there. And I think that you're fighting with short-term still supply interruptions, hiring interruptions, and some short-term challenges that are inflationary versus a long-term backdrop of deflationary trends because of AI around the globe. I think that's sort of the center of conversation. When I'm back here in 2026 and 2027, I think rates will probably be a bit lower because of the technology impact. But I think in the next 6 to 9 months, I don't think rates are going to be dramatically lower.
If you'd taken 6 months off and came back to work and looked where the market was, I don't think you'd have a clue anything had happened here. Equities close to all-time highs. Credit spreads are very tight. It's not a market that's screaming out for rate cuts. From your standpoint at Apollo, when you look at valuation, underwriting, any red flags getting your attention at all at the moment?
The economy is amazingly resilient in the U.S. When I was here 3 or 4 months ago, there was concern, hand-wringing about the trajectory of the economy. There was hand-wringing about non-U.S. investors, global investors investing in the U.S. I've been all around the world the last 12 weeks. American exceptionalism is front and center back. You talk about where valuations are and levels of equities and rates, they're back. Global investors want to invest in the U.S. They made a lot of noise. They thought they were going to diversify themselves away, and they realized the breadth and depth and the strength of the U.S. economy and the scale of what they need to invest. And the U.S. is the primary place to invest. It still is. So, it's very interesting. I was in Europe a few weeks ago. I was with your folks. I want to talk about that. Amazing things going on in Germany right now. The reality is public markets are the narrative, but private capital drives the economy. And we're seeing it. We've been amazingly active. ED&F last week, Lottomatica, what's going on in a variety of financing. So it's been a very, very busy time, but I'm not seeing any red flags going off. And I want to make sure we talk today about this concern about the private capital, private credit bubble versus just an economic cycle. We're due for a credit cycle, but that does not mean it's a bubble. And private capital is playing a bigger and bigger role. Look what we did last week for ED&F in the UK and Germany. $4.5 billion sterling, private capital financing, long duration debt to finish out their nuclear power plant build. Really, really important that we're playing that role.
We'll sit in Europe. Let's just stay there, off the back of your travels. So you mentioned ED&F, big sterling transaction. Yeah. Also a big target from you and the team to invest, 100 billion in Germany over the next decade or so?
Yeah, if your leadership a journey right now, your goal is to get a 4 trillion economy to a 6 trillion economy. And you are, I was with the administration, you can talk to MERS, they really are embracing the role of private capital along with government spending over the next 5 or 10 years.
They've been so dependent on the banking system in Europe for such a long time. Can they get away from that? Because I feel like I've been talking about this for more than a decade.
Well, I think the evidence is there. If you look at the last 24 months and what's going on with the leading Italian banks, look what's going on with HSBC, look what's going on with Barclays and Deutsche Bank. They're operating in a much different capital regime with a focus on shareholder value, with the focus on ROE, and they're really, not taking all the policy lending on their balance sheet like they had in the past. So they're actually operating the right way. What you didn't really see before is the government really embracing in Germany, in France, in the UK. They want private capital to be part of the solution because they know the government balance sheets cannot do all that's needed in terms of the massive capex of transmission line, of transportation, of AI, of data centers. They know they're behind. So if anything, this administration in the U.S., the memo they sent out about what's going on in the U.S. and Europe stepping forward, European leadership has taken notice. Let there be no doubt. I go to Europe 3-4 times a year. I've never been so embraced as we were 3 weeks ago in Germany and France about the role of private capital in this build-out.
How much is that driven by this U.S. administration?
A lot. I mean, it's clear that they know that the European leadership has, even if you look this morning about how they're stepping up on defense spending with NATO. So I think, when I think about the globe right now, again, tariffs are a little bit off on the sidelines. They're part of the conversation. It's a question of how much, not if or when. And I do think they feel like there's a responsibility that they have for their citizens, because when you look at the last 15 years and where the U.S. has grown versus Europe growth, it's startling. When I got out of college a few decades ago, it was all about Japan. Japan was going to take over the world. It was all about Germany, industrial, taking over the world. That did not come to play, and I know they have a lot of catching up to do. And I just think it's a very, very now. If you read the Draghi letter and what he put forth 18 months ago now, if they followed that all 156 pages in great detail, it would be a watershed economic opportunity. And I think parts of that will come forth. But they're already making moves on securitization, other activities. And to Jonathan's point, the European banks are a bit behind the U.S. in terms of the fundamental focus on ROE and shareholder return and capital efficiency. But I think I don't want to say they're catching up, but they're getting in line, clearly. And equity investors have taken notice.
You're going to stick with us. Jim Zalter of Apollo is going to stick with us through the next 15 minutes or so. In the meantime, let's check out the market, up by about 1/3 on the S&P, and let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. The Wall Street Journal is reporting that President Trump may announce Fed Chair Jay Powell's replacement as soon as September, sparking speculation that rate cuts will come sooner and go deeper than markets had priced in. The president said he has 3 or 4 people in mind for the job. Meanwhile, the GOP remains divided on the SALT cap. Earlier this week, Treasury Secretary Scott Bessent met with Republicans to try to resolve their differences. But Congressman Lilota of New York said they are, quote, far from a deal. Meanwhile, Senate Majority Leader John Thune still thinks they can get a bill on the president's desk by July 4th. And Micron shares are rising nearly 2% in the pre-market after the chip maker posted third quarter results that beat Wall Street estimates. It also gave an upbeat forecast for the fourth quarter. Micron is on track to post record revenue this fiscal year, fueled by strong demand for its AI equipment. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes from now. Up next on the program, Chair Powell's replacement.
I was wondering if you've begun interviewing different candidates for the Fed pick.
Yeah, I know within 3 or 4 people who are going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible.
That conversation up next with Bloomberg's Tyler Kendall, plus more from Jim Zalter of Apollo, live from New York City this morning. Good morning.
a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance. Live from New York City this morning. Good morning to you all. Equity futures on the S&P positive here by 0.4%, up by 0.5 on the Nasdaq 100. A lot of attention on the Federal Reserve this morning. Under surveillance, Chair Powell's replacement.
I was wondering if you've begun interviewing different candidates for the Fed pick.
Yeah, I know within 3 or 4 people who are going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible. He's an average mentally person. I'd say low in terms of what he does, low IQ for what he does. I think he's a very stupid person, actually.
So here's the latest this morning. President Donald Trump saying he has 3 or 4 people in mind to succeed Fed Chair Jay Powell. The Wall Street Journal reporting the president might announce his replacement earlier than expected. With the latest, here's Tyler Kendall. Good morning, Tyler.
Yeah, hey, John, good morning. So this isn't necessarily surprising, right? President Trump has been ramping up his criticism of Jerome Powell in recent weeks and likely wasn't too happy with the Fed chair's testimony on Capitol Hill. I was there when Jerome Powell reiterated that the central bank is in wait-and-see mode amid so much uncertainty when it comes to this White House's economic policies. And yes, of course, tariffs is at the forefront, but I'll also point out his comments about a shift in immigration policy by this administration that's contributing to a curb in growth when it comes to the labor market. Now, for context here, when Jerome Powell was originally nominated, he had a 3-month runway to get through the Senate confirmation process. But if we're talking about President Trump naming somebody in September, that would be an 8-month gap to May of 2026. Now, our analysts at Bloomberg Economics say that whoever is chosen here will likely have the best chance of getting chosen if they meet 3 main criteria for this White House. One would be loyalty to the Trump administration. The second would be credibility for the markets. And the third would be what they call unconventionalism vis-a-vis the economic establishment. Essentially, the White House would be looking for somebody who wouldn't be afraid to buck the trend. Now, we should say there is, of course, so much uncertainty like many things with this administration, but our analysts are pointing to potentially NEC Director Kevin Hassett as being one of the most likely choices because he could say after he's done with the one big beautiful bill that it's mission accomplished and he's looking for a job outside of the White House.
Tyler Kendall with the latest. Tyler, thank you. This is September. Think about how far away September is and what could happen in between. July 4th, tax bill. July 9th, trade deals. Could be in a completely different position in September.
Jim Zelter said it best. This president has already won because the headlines are this, and not all of those issues that are coming up on the floor in less than 2 weeks that are pretty major potentially for the market and the economy.
The president of Apollo Global Management still with us. Jim, let's continue this conversation. You've talked about macro paralysis in the past. I don't see any sign of paralysis when I look at, say, high-yield issuance, when I look at activity. Do you see paralysis at all?
I don't. And back to this last topic, I mean, as you point out, Lisa pointed out, the 2 big topics that they need to really deal with right now is the tariffs on July 9th and the big, beautiful bill. But we're not talking about that this morning. We're talking about a Fed chairman in 9 months. And I look at everything through what this president has been in the past. As a real estate developer, it's all about location, location, location. The Fed pick will be about loyalty, loyalty, loyalty. Let's not get confused. There isn't paralysis in the market. As I mentioned before, you know, the public markets are the narrative. The private capital is really the driver of the economy. A lot of activity going on in the U.S. on refinancing, in Europe on the global industrial renaissance. So we are on pace to have our busiest quarter in origination we've had in a number of years. A tremendous amount of activity across our equity platform, our infrastructure platform, our credit platform. So I do think there was a lot of hand-wringing, as I said, 4 months ago, and I think that's now on the sidelines, maybe not on the narrative, but certainly on activity.
Is that activity in lieu of some of the deals activity that we were expecting? Was it sort of expected to be the deals and the IPOs and the big boom for the banks, and instead it's Apollo coming in and doing a lot of financing deals in the back?
Well, I think two things. I think at the beginning of the year, people projected that the busiest folks on Wall Street would have been the ECM, equity capital markets teams, and the M&A teams. And while they've both been busy, the busiest folks have been the rate hedging and derivatives teams because of what's gone on in the dollar and concern about tariffs and such. But it's an interesting backdrop. Even listening to your program this morning, the fundamental economy is doing fine. It's doing well, maybe not to the growth expectations that people had earlier this year, and we'll come out somewhere around a 2% growth with about 3% inflation. But whether it was NVIDIA, whether it was Micron, a lot of CapEx still going, a lot of companies in the AI space raising tremendous amounts of capital at high valuations with long list of investors coming in. And the activity, as I said earlier, what's going on in Europe right now about that industrial renaissance, it's still going on. So again, I think there's the headlines and then there's the reality of the underlying economy and the role of private capital, which is a much, much bigger, longer-term story.
How do you think you're going to decipher the reality versus the headlines when it comes to New York City? You have a huge company here in New York, and a lot of people are concerned about a democratic socialist becoming the mayor of the city.
You know, it's probably one of the most complicated jobs in the world on the political stage in terms of bringing a variety of the 5 boroughs together, the business, the community, the unions, all the folks that make New York the special place it is. As I mentioned before, 3 out of every 100 college graduates a year come to New York in the U.S. It's still the magnet of talent and ambition. So when you see somebody that on the surface does not appear to have a long resume of leadership and making tough decisions, really concerning. And I think that we'll see now, just winning the primary, while in the past it might have been the litmus test for being the mayor, I think there's still a long time coming until November.
Build out the office in Florida. Is that what you're hearing?
That's, I mean, Texas. It was the most diplomatic response ever.
We are. Listen,
Look at the resume.
We are a New York company.
There we go.
We are determined to be here. I'm determined to be here. Our leadership's determined to be here. We have people in the office 5 days a week.
He's running.
You know, it's no, I'm not running for mayor.
Jim, it's good to see you. Happy birthday, Jim South of Apollo. Some great hires in the last few months over at Apollo as well. Brian Weinstein, friend of this show. Fantastic over at Apollo now. Jennifer Lynn as well from JP Morgan.
We will get both on in the next several months along with Eric Needleman.
I'm sure the banks are thrilled with you guys. Up next on the program, Mike Schumacher of Wells Fargo on increased defense spending weighing on bonds. Plus, Danny Berger on the latest movers. We'll take a look at AMD.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
60 minutes from now, some important economic data. Look out for jobless claims for another read. A refresher on what's happening with the labour market. Here's stateside. Stateside in the equity market, positive by 1/3% on the S&P, up by 0.5 on the Nasdaq 100. Let's get you some morning movers before we get to that opening bell. 2 hours away is Danny Berger. Hey, Danny.
Hey, John, some earnings to work through. We got Walgreens Boots moments ago. Shares are up only 1/3% despite the fact it was a healthy beat. They are seeing a more successful turnaround, but just want to be very clear that this stock does have a ceiling on how much it can move in, a floor, because it is going to be taken private by Sycamore Partners at the end of the year. But for what it's worth, solid earnings from Walgreens Boots also is a positive for other stocks like CVS. We also heard from McCormick. This is the spice maker that you so often see in grocery stores. The expectation was that this was another company that would come out, have to downgrade its outlook because of the tariff hit, because of higher input costs. Instead, what we got from them was a hold and a no change to their outlook. That's enough to send shares up almost 5%. They said that they have the capability to offset and mitigate